Hit it.
It's Friday, December 4th, 2020, episode 108. I'm Patrick Ceresna.
And I'm Kevin Muir. This week we welcome to the show Eric Basmajian from EPB Research. Eric comes on to give Kevin's MMT-here-comes-inflation-thesis a dose of cold water. And then it's Kuppy's Corner time. You don't want to miss this one.
In This Week in Trading History, we go back to the merger that made one of the world's largest oil companies, and we end with our segments of No Stupid Questions and Skin in the Game. And folks, we might even drink some beers along the way, so stick around. We got a great show. Lena, hop on. What beer are we drinking this week?
Today we're drinking Great Lakes Brewery's Burst, a New England Pale Ale. Get ready for a flavor burst with this 4.5% New England Pale Ale. The hazy light golden liquid flows beautifully into your Great Lakes Brewery glass and produces a tight white crown. Predominant notes of mango propel forward and are quickly joined by strawberry, peach, and a touch of lemon. Subtle sweetness makes an appearance too. The soft mouthfeel provides a creamy texture. Juicy. Again, back to mango and strawberry with honeydew melon tagging along on the hop rocket. Really bright on the palate, like drinking a fresh fruit salad, if that's a thing.
I love it, actually. This is good.
I love it, but that's that soft mouth thing. When people say that, it just, I don't know why. It gives me the heebie-jeebies.
We're just talking about beers. Get your mind out of the
I know, but it's just not the right adjectives.
All right, Kev, give us a disclaimer, buddy.
Okay, nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much huddle may include TELSA tachycardia, bond barbiturate bursitis, and then my favorite, U.S. dollar vomitive vaccination. I was desperate this week, folks. Okay, on to the guests.
All right.
It's our pleasure to welcome to the show right now Eric Basmajian. Eric, welcome to the show.
Thanks so much for having me.
Eric, thanks for being with us. You actually come highly recommended from Lynn Alden, who said that if we're looking for somebody that's willing to talk about the other side of the reflation trade, you're the man. So why don't you tell us, though, before we get to that story, how did you end up, having your own research shop?
Sure. So I studied economics at NYU. And after graduating, I spent about 2 years working at a quantitative hedge fund in Midtown Manhattan, working on some statistical techniques, some programming, things like that. My bias was still with macro, though. There wasn't a whole lot of macro over at the quant shop. So I continued my study of economics on the side. And the two people that influenced my thinking the most were Dr. Lacy Hunt for the long-term structural view on the economy, and the late Jeffrey Moore, dubbed as the father of leading indicators, I believe co-founded the Economic Cycle Research Institute, which is still around today. I think, Patrick, you've talked with Lakshman before. So those two economists influenced my thinking the most. And I started to use some of the statistics and programming that I had learned to marry those two strategies together, and started publishing some of my work in 2017. Gained a fair amount of traction pretty quickly, so I decided to leave the fund and start EPB Macro Research in 2017, and here we are today.
That's a great story. I know Patrick got all excited when you said that one of your mentors or one of the people that you look up to is Lacy Hunt. Patrick also looks up to Lacy Hunt. His bedroom has pictures or posters of Lacy on the wall. I hope yours doesn't, Eric. But it's interesting because you are a young fellow, and yet you're in this kind of view that is actually more traditional. So why don't you walk us through, though, why us older guys that have embraced some of the MMT and the other reflationary ideas might be wrong? Like, what are we missing, and what are we getting, kind of incorrect that you see?
Sure. So I think I'll take that in two parts. So first, I look at the long-term structural view in the economy. And if you want to pop over to slide 3 of the deck that I sent you, this is obviously the long-term structural trend in the economy. And that's one way to look at it. But we also have the business cycle and these multiple quarter increases or decreases in GDP growth. And those two trends can be separate. So obviously in this chart here, since 1980, it's been a one-way street down. But we've had many cyclical bouts of reflation within this trend. So I believe that this long-term trend will continue, but to contextualize the conversation, when we look at some of the shorter term leading indicators for the next couple of quarters, we are seeing the leading indicators perk up. So I believe that the reflation trade will work over the next couple of months. But given the structural trends in the economy, I believe that the reflation trade will run into the secular ceiling, similar to the way it did in 2018. If you recall, in 2018, we had a big cyclical reflation, and I believe the consensus mistook that as a structural shift versus a cyclical shift. And once the Fed ended up raising rates, confluence of other factors, the cyclical trend turned down and reconverged to the long-term secular trend. So I think what's going on today is not going to be dissimilar to that. I think we have a strong upturn in the leading indicators, particularly in the manufacturing sector, things like industrial commodities, ISM, new orders to inventory spread, US dollar, manufacturing hours worked. All of those things are pointing up. So the reflation trade certainly is going to have some legs over the next couple of months, but the long-term trend is going to reestablish itself once the higher interest rates start to reset against the debt overhang that we have, and that's really the crux of the long-term thesis is the debt overhang.
So let's talk about that, and I guess that secular ceiling, as you so elegantly put it, is really the crux of your argument. What is driving that secular ceiling? Like, why does it occur?
Sure. Okay, so let's go over to slide 21. Slide 21 is the national savings and investment identity. The national savings and investment identity is an identity, which means it has to hold true. It's not a theory. And if we rearrange the equation here, we see that government borrowing is equal to domestic savings plus the inflow of foreign capital, which is the trade deficit, minus domestic investment. So when government borrowing goes up, which we all know that it is and is expected to continue, one of three things has to happen for the equation to balance. Domestic savings has to go up, which would mean lower consumption. Foreign capital, the inflow of foreign capital would have to rise, which means that the trade deficit would have to explode, or domestic investment would have to tank in order to make that equation balance. Now, it doesn't always happen where one leg falls and the other doesn't. All three tend to happen at the same time, but when we look at this equation and we think about what's happening, if we go to the next slide is net national savings. And net national savings actually turned negative because net national savings is a combination of household savings, which is positive, government sector savings, which is negative, and corporate. So the household sector and the corporate sector are not saving enough to offset the government, which is why we have a negative net national savings rate. And if we have a net national savings rate, that means that we need a lot of help from the trade deficit unless we want private domestic investment to fall apart. And what we see in the next chart is that the trade deficit, this is the goods trade deficit, is rising. The trade deficit's getting bigger, but it's not getting bigger at the same speed as the deficits. And the savings rate is obviously going down, as we just looked at. So what's the leg that has to fall? The leg that has to fall is private domestic investment. If you go to slide 28, we have here private domestic investment in structures and equipment as a percentage of GDP. In the 1980s, we were up almost at 13%. The average since 1947 has been almost 10%. And this ratio has just been collapsing as a result of the national savings and investment identity. If you go to the next chart, it's just a little bit more zoomed in. And in Q3, even though we had a 33% GDP quarter, private domestic investment as a percentage of GDP still went down. Why? Because we borrowed a tremendous amount of money and the net national savings rate was not able to offset it. We're not able to offset it with the trade deficit. So the leg that falls is private domestic investment. And structures and equipment are things like hospitals, power plants, power grids, machinery, all things that boost productivity. So as we continue to pursue a path of increased debt, and we're not saving enough to offset it, and some of the global trends are not lending themselves to the trade deficit covering the gap, we're going to see private domestic investment, particularly structures and equipment, continue to deteriorate, and that's going to really weigh on the productivity of the population. And we know that long-term growth is a function of productivity plus population. If we know population is declining and we have a strong sense that productivity growth is going to decline because of this chart, then the long-term trend in the economy, as long as we continue to operate under this framework, is going to continue to be down. There's almost no way around it as long as we continue to operate under the same framework with the same laws that we have today. Obviously, that can all change, in which case a lot of this would change. I mean, if Dr. Lacey Hunt's line in the sand, as I'm sure you know, is making the Fed's liabilities legal tender, that would change this equation, because then the Fed would be able to offset some of the lack of savings.
Okay, before we get there, let's just talk about if under the current circumstances, what would happen. So let's just walk through it in terms of, if I understand this correctly, that the government is spending too much and crowding out private investment, and therefore that's not occurring. Is that correct? Is that like a simplified version of what you're trying to say?
That's right.
Okay, so now the economy gets going, and this is occurring, and how does it, back to the secular ceiling, which seems to be a ceiling that keeps going lower and lower. And why don't you tell me like how you would envision, if nothing changed, this next cyclical upswing to play out?
So I would expect the next cyclical upturn to play out similarly to the 2016 to 2018 upturn, pending what the Fed does. I think it's going to be the same in the sense that there is a fair amount of momentum behind some of these leading indicators. So we can get a bit of reflation here, and then that can feed on itself if stronger manufacturing improves employment and incomes and things like that. But eventually, what I think is going to happen is that long-term interest rates, the natural direction when you're in a cyclical upswing is going to be up. So we're going to see, like we have, the long end of the curve start to go up. And when the economy is too indebted, the higher interest rates start to cut into growth. So if we have $80 trillion worth of debt across all four sectors of the economy, household, government, corporate, and financial, and a certain percentage of that debt resets every couple of years. The debt gets so high, if our nominal GDP is only increasing $600 billion a year, $700 billion a year or so, and we have to reset into $200 or $300 or $400 billion higher interest expense, we lose half our growth just by rates rising. So I would expect this upturn to play out in a similar way, where we have a reflation that gets going, long-term rates back up. That's going to slow the housing market, and then it'll start to slow everything from there as well. The counter argument is that if the long rates start to back up, the Fed will cap them. And we can talk about that.
Well, yeah, let's not get there. Yeah, let's just talk about what happens in a regular environment.
Right. So in a regular environment, yeah, go ahead.
Sorry, go ahead. I was going to say, so this is your argument about why over the last 40 years, every peak has had a lower and lower kind of interest rate before it kind of peaks out, meaning that after 81, interest rates went down and then they went back up, and it took, maybe they went from 15 down to 8, or I don't know what the number is, and then it took to 12, and that caused the economy to stall. And then the next time it went down to 4, and then back up to 6, and at that time it caused the economy to stall. Each peak has been subsequently lower and lower and lower, and we're finally hitting the points where there's barely any peaks at all, and you're arguing it's because of all this debt that we keep piling on. Am I correct?
Exactly. And if we carry this through all the way to a more extreme situation like Japan, we're not there yet for a variety of reasons. We're not there in terms of debt, and we're not there in terms of how poor their demographics are. But if you look at Japan, where this ends up going is that right now in the U.S., the structural trend is down. And every time we have a cyclical downturn, it pushes us just near a recession, but we don't quite get there. We had a near recession in 2012. We had a near recession in 2016. Then we had a near recession again in 2019, which was then we started to have a cyclical upturn again before COVID happened. But every time we have a cyclical downturn, it pushes us right down to the edge of a recession, but we end up recovering and moving forward. In Japan, because their trend growth rate has been pushed so low, close to zero, every single cyclical downturn is a recession, which is why they've had, I think prior to COVID, maybe four recessions after the great financial crisis, because their trend and Europe is just a step behind Japan. They've had more frequent recessions than the United States. And as we see these economies get more and more indebted, what we're going to see is more frequent recessions as a result of just cyclical ebbs and flows in the economy.
Okay, so that's what I wanted to talk about. Let's just not assume that anything changes and say under the current old regime, we continued under this path. You would argue that we're going to have more frequent recessions, and it's just going to, and the upswings will be lower, and it'll just basically cause our growth to be lower and lower and lower. Is there eventually a point where it implodes on itself under your kind of model, or like how would it eventually resolve?
So if you want to go to slide 5, this is probably the best chart that I think is not well understood. This is the very long-term 20-year annualized growth rate in real GDP per capita. This chart is critical. So real GDP per capita is effectively the standard of living. And there are a couple of things to note in this chart. One is that we've obviously declined pretty significantly in terms of our real GDP per capita. But as the econometrics tells us, the decline is getting nonlinear, meaning that it's declining at a faster and faster rate. And the econometrics tells us that under the exact same framework that we have, the same set of rules, if we continue to pile on this debt, this real GDP per capita is going to converge to zero and then go through zero and go lower. Now, this is a very long-term chart, so it'll take some time, but the nonlinearity of this decline should continue. And what we're seeing, and this gets a little bit outside of the realm of markets, is that if the standard of living for the entire country is growing at 1%, which it has over the last 20 years, this is just the data. That means that there's a significant percentage of the population that's below zero, and then a smaller subsection of the population that's above zero, because we know there's tremendous disparity. So what's going to end up happening is we're going to have a larger and larger and larger share of the population that has a declining standard of living, which typically doesn't end very well. There's a lot of social unrest that comes with that. So we're getting close to a tipping point now where real GDP per capita of 1% is pushing, getting close to a majority of the population that's going to be experiencing a declining rate of or a negative improvement in their standard of living. So where this implodes on itself is if the social unrest gets so extreme that they force a change in our operating framework to something like an MMT that does allow the Fed to more directly control the money supply versus just the monetary base.
Okay. So before we get to that, where we're headed in terms of kind of the current change in the framework of how we're thinking about economics, I want to talk about the people who would, subscribe to your economic theory. How would they recommend we get out of this problem?
Well, there's no pain-free way to get out of the problem, and that's usually what people are looking for. But the solution is we're going to have to reduce the rate of growth in our debt. Now, we don't have to. I mean, of course, we'd like to get back to as close to a balanced budget as possible, but eventually we're going to have to battle with some of the future entitlement issues that we have, because we have a tremendous debt burden now, but the similar problem in Europe and Japan and the United Kingdom, where the future liabilities are an even greater problem. So we're most likely going to have to alter those future liabilities, which by definition is some form of austerity. We have almost all of our entitlement payments are linked to inflation. Entitlement meaning Social Security, Medicare, Medicaid. If you actually go to slide 35, transfer payments linked to inflation. This was a study These are all the transfer payments that are in some way either explicitly or implicitly linked to inflation. So when we start talking about is the solution to debase the currency, it's not going to help at all with the future situation, because if we get the CPI to 4, 5, 6%, our future spending will go up by an equal amount because we've linked everything to inflation. The slide before is Larry Kotlikoff, who pioneered the concept of the fiscal gap. And he commented on this, saying that money printing is going to generate very little traction because all of the future spending is indexed to inflation. So going back to your question, how do we solve this? We have to reduce the rate of growth in debt. One way to do that is to reduce the link to inflation, but that makes an entitlement program sort of useless because in 10, 20 years, the payments are so diluted. But one way or another, we're going to have to slow the rate of growth in debt and force the country to have a higher savings rate. And in time, the higher savings rate will then allow us to invest more in private domestic investment and reverse that trend. Because if we recall that trend from earlier, if that trend persists and private domestic investment falls from 13% of GDP to 8% of GDP to 5% of GDP, we're going to cripple our infrastructure at an accelerating rate, and that's going to really make the standard of living quite poor. So the solution is some way of reducing the rate of growth in the debt.
But isn't it more than just the kind of reducing the rate of growth? Don't we actually have to not only reduce the rate of growth, but flip it and make it so that we are making the amount of debt decline?
If we look at debt to GDP, if GDP is going to increase, if we go back to the you don't have to go there, but the first slide, nominal GDP, the long-term trend, nominal GDP has been increasing at about 4% annualized over the last 20 years. So if we were only increasing our debt at 1%, technically our debt to GDP ratio should over time start to work lower. And to make the solution more palatable, it's difficult to go from 6, 7, 8, 9% deficits to a surplus. So I think if we just start to try and move to tempering the rate of growth in the deficit to something like 1%, if that's more palatable, that would, I think, benefit us over the long term.
Okay, so for you, you think that government deficits are ultimately our real problem. That is what is the kind of holding us back as a society.
I think that's one of the main problems, because the government tends to have the most negative multiplier.
Right.
If you flip to slide 16, we can flip through these quickly. This is the government debt to GDP, and what I did was draw a couple lines of these debt thresholds. And these aren't lines that I made up. I have all the research docs in this deck that support these thresholds. But what we know is that there's a threshold of debt to GDP in every sector of the economy. And once we cross this threshold, the multiplier on the expenditure starts to get very negative. The government sector is the furthest beyond this threshold, which is why the debt in the government sector is going to have the most negative impact. But if you flip to the next slide, household debt, we were above the threshold in the lead up to the financial crisis. We're just about there now. If you go to the next slide, non-financial business sector, just about there. And that's total non-financial. And then the last chart is the total pile, including financial sector also. And basically what we see here is that every sector is at or beyond the diminishing marginal returns threshold, which means that debt accelerations in any sector are likely to have really lackluster results. But given that the government sector is the furthest beyond the threshold, the negative multiplier is going to be the greatest there.
Right. Okay. So now when we're stuck in this COVID situation, all of a sudden the government's spending tons of dough, and you're seeing all these debts go through the roof. And then not only that, these MMT folk are all over the airwaves, and you must just be throwing up a little in your mouth every time you hear that. Is that right?
Yeah, I think that what we're all trying to do here, as far as the economy is we really need to increase the standard of living. That's the biggest issue. And the standard of living is real GDP per capita. And I've yet to see even the MMT crowd formulate an argument that MMT will boost the real GDP per capita. A lot of the MMT arguments are centered around devaluing the currency and getting these debt to GDP ratios down. But by doing that, I feel that we're going to continue accelerating the rate of decline in the real GDP per capita, which means that the standard of living is going to keep getting worse. So I don't see the merits to that solution at this current point.
So when they argue that basically a government is not financially constrained, they're just real resource constrained, you don't buy that at all?
I think the national investment savings and investment identity proves that to be false, and I think that the evidence that the identity is working is that private domestic investment as a percentage of GDP is falling apart. So the notion that the Fed can quote unquote buy it and fill the gap is proving untrue.
Okay, so now let's talk about, you were mentioning the fact that there is kind of something that Lacey Hunt has alluded to, and there is a way around this that would actually create the inflation, and that is the Fed monetizing it through, why don't you, like, I don't really understand exactly where your crew differentiates, so why don't you tell me what they might see that causes what we have seen previously, which was declining levels of inflation, to actually for that trend to reverse? What would be the trigger?
So for me, the line is, one way to think about it is, right now, when we spend money, when we quote unquote print money, that term is used in a million different ways, but some people say, we're gonna print the stimulus checks, meaning that the government's going to issue the debt and then the Fed's going to buy it. But basically what we're seeing now is, for every dollar that we spend, either taxes have to be collected or debt has to be issued. The difference is, if we cross into a regime where we can start spending money without any increases in debt, then the velocity of money won't decline as fast. And the money supply growth will obviously go up. If GDP's money supply times velocity, and you get money supply up and velocity doesn't decline, then you're going to get your inflation. And the velocity is not going to decline if there's no debt to hinder the velocity of money. So the difference is, right now, for every dollar we spend, we issue debt or collect taxes. If we change the environment to the Fed can all of a sudden send everyone $1,000, but there's no increase in debt on the other end of it, then we can't do that right now. But if we do that, either through a law change or we just decide to override the laws and just do it anyway, that would be a total change.
Okay, but one of the things that I kind of have trouble with on that argument is if the government was to give everyone $1,000 and then they issue bonds and then the Fed buys those bonds and leaves them on their balance sheet forever, is that any different from what you just described?
It is, because right now we operate under a floor system right now. So what happens, and if you actually go to slide 38, the whole concept of fiscal QE or fiscal spending, George Selgin wrote a whole book on this. And we also have notes from the Fed, the Atlanta Fed. What happens when the Fed does QE? So we send everybody checks, we issue 10-year notes to pay for it, and then the Fed goes to the banks and buys the 10-year notes and gives them a reserve in exchange.
Right.
The reserve pays interest on excess reserves, and the securities portfolio that the Fed has pays interest as well. And I think what a lot of people believe is that the Treasury sends the Fed interest, and then the Fed sends that interest right back to the Treasury. Now, that's in part true, but in a floor system, what happens is the Fed has to pay the banks interest on excess reserves. So what happens is the Fed buys the long-term bond, issues an overnight deposit, and then has to pay interest on excess reserves. So all we're doing here is we're changing the composition of the government debt. There really wouldn't be much difference here if the Fed issued all the debt at T-bills. The problem is there's just not enough demand for all those T-bills. But it's not like the federal government's getting a free ride here. All they're doing is they're taking a 10-year note that maybe yields 90 basis points and converting it to an overnight deposit, paying 10 basis points, and then they remit the difference back to the Treasury. So, there really wouldn't be a whole difference here to me if they just issued the whole thing at T-bills, if they were able to do that.
Okay, but wait. I don't disagree with you that it's composition, but they still, if the government spends, issues a bond, Fed buys the bond, leaves it on, or buys a T-bill, leaves it on their balance sheet and then perpetually rolls it. How is that different than the government just spending money that they create out of thin air? Or the Federal Reserve?
Because the overnight deposit still sits on the books of the Fed, and still sits on the books of the banks. And if you go to slide 39, we have a reduction in bank lending growth because we keep the banking sector, and this is why the national savings and investment identity holds true, is because the Fed can't be a source of savings. They could only swap assets. So the banking sector is still taking down the debt either as a long-term note or an overnight deposit. So the banking sector is not really feeling any difference between holding the 10-year note and the overnight deposit. So the rebuttal would be, how would this be any different if the Fed didn't do QE and the banks just held all the 10-year notes? Because what we see is, the next slide, securities in bank credit is rising rapidly beyond what they're exchanging for the Fed and QE. So we're still stockpiling the banks with all of these securities, which is preventing private domestic investment. So either by stuffing them with reserves or stuffing them with actual securities, we're still hindering the rate of private domestic investment and the percentage of loans as a total bank assets. That's the slide 44. So if there was no impact, we shouldn't see loans and leases as a percentage of bank assets on a secular decline, not just in this new QE regime.
Okay, so when your guys are talking, you're saying that if we do a change that allows the Fed to issue money directly. Now, I always think it's funny that they're using the Fed, because to me it seems makes more sense for the Treasury to do it. And the Fed to just, let's just talk about, is this similar to the the $1 trillion coin or whatever it is?
Exactly.
The $1 trillion coin would work for you in terms of creating inflation.
That would.
Okay, so why don't do you want to tell people what the $1 trillion coin idea is and how it works?
So the $1 trillion coin idea, if I am thinking of the same thing that you're thinking of, is that the Treasury mints a $1 trillion coin that doesn't circulate and hands it to the Fed, and then the Fed hands $1 trillion to the Treasury that they can then spend.
Right. Exactly.
That's what you're referring to.
Right. So it's a way around because right now, if the government runs a deficit, by law have to go out and borrow those funds. And that is a self-imposed issue, but it is definitely an issue.
And I think one of the differences there too, if I can just interject, is that the $1 trillion coin wouldn't circulate in the public. So technically the Fed can just say, poof, the $1 trillion coin is gone. You can't do that with treasuries because they only own whatever it is, 18% of the market. So you can't just poof half the treasuries away and remove all that bank capital. So the fact that they're, if the Fed bought every single treasury in circulation, they could theoretically do the same thing, but that's not really feasible.
Well, Japan's working hard on it, though, aren't they?
Well, actually, that actually is one of the reasons why they have to start switching assets, because they're going to end up buying every government security that there is, and there's demand for government securities for regulatory reasons and a variety of other things. So They actually end up having to. They almost get forced into buying stocks. Right. Because that's
all that's left.
All that's left.
So let's, we've been talking a lot about theory and different aspects of it. Let's talk about what you think is going to happen now. So given the current environment, you see how this is all playing out. Where do you think our government officials, our society is headed, and how will that affect your investments and the economy going forward?
So I think that there's a lot of speculation of changes to different laws and different proposals. I'm not terribly optimistic on all that much changing over the next couple of years, particularly if we hold a divided Congress. So I would expect that the fiscal situation in the U.S. is going to get increasingly worse, just structurally because of demographics, most of the entitlement payments over the next several years. So the U.S. fiscal situation is going to get worse, and that's going to lead to lower private domestic investment, all the things that we talked about. So I believe that over the next several years, we're going to see all of the same trends that we saw over the last 20 years repeat themselves and continue and actually get worse, because we've now surpassed all of these diminishing marginal return thresholds where these declines should start to get nonlinear. With that said, over the next several quarters, we have a strong reflationary trend here, partly because COVID shifted so much consumption towards durable goods and away from services that we have this manufacturing restocking boom that's going on. So I would expect the inflation rate and the long-term rates to be under pressure. And the Fed may decide to shift their purchases to the longer end. I'm not overly focused on what they do with QE. I don't think it's as important as these long-term trends. So I believe that over the next couple of months, you could position for your reflation, but you have to keep a close eye on the leading indicators of the manufacturing economy, because as soon as we have another global industrial slowdown, we've had 3 of them since 2008. Once we have another one, that disinflationary wave that comes over the global economy is going to come over again. And I think that next downturn is going to push long-term rates pretty close to the zero bound. And that's going to present a whole new host of challenges for the Fed with talking about negative interest rates and things like that.
Okay, so let's get to that. But before we do, let me just understand. You're in the camp, you agree with all the inflation bulls that the next few quarters are up. Like, there's no doubt about it. We're headed this way. And then the real question is, when does this secular ceiling kick in? You know, some of the people on the MMT camp and the people who believe that fiscal has really changed the whole environment. You take the other side of that. You say sold to them. You think that bonds, in terms of rates, top out way more quickly than people expect. I'm looking here at the chart. In 18, the 10-year was over 3%. We're right now at 98 basis points. Does it, are you thinking 2 or 2.5?
You know, I'm not all that good at targets.
No, but just kind of roughly.
Direction guy. But I would expect another lower high relative to that.
Okay.
To that point, because partly, remember we raised the Fed funds rate to 2.5. I don't think we get anywhere near that on this go around.
Okay.
So yeah, I think that the bias is upwards, but I would look for a top or a lower high relative to the last cyclical upturn. And my judge of that, I'm not much into technicals, so my judge of that, rather than the chart, will be the leading indicators I follow in the manufacturing sector. When those turn lower is when I would shift back to my overweight position in long bonds and try and ride the next downturn.
Eric, you're not much into technicals. You and me both. I think it's voodoo magic. Okay, so now we go through this. We have a year or whatever it is of uptick. Let's say the 10-year goes to 2%. Those leading indicators turn back down, and we head lower. Let's talk about this. You mentioned zero rates, negative rates even. What happens in this next one, which is, I guess what you're saying is the really scary one?
Yeah, the next one's going to be tough, because if we operate under the assumption, now for this conference, let's just say the Fed is absolutely not going to do negative interest rates, and as a result, there's a hard floor for nominal bonds. Let's say 10-year bonds, there's a hard floor at 0.
Okay.
So what's going to happen is, if this next downturn comes, and during the COVID crisis, it pushed the 10-year down to, I think, 30 basis points at its lowest. But if we start to go down to there and the 10-year hits 0, but inflation expectations keep coming down and the nominal bond yield's not able to cross 0, that's going to cause the real interest rate to start to move higher.
Wow, okay.
And when the real interest rate starts to move higher, that's your really draconian asset catastrophe scenario.
Okay. Before we get there, why would there be a hard floor on the 10-year? Couldn't we invert, and couldn't we see it trade negative even if rates aren't going to go negative?
We could.
Fed funds.
We could. That's possible. I would say that.
If you're saying the Fed's never going to go 0, the market would be foolish to take it below 0. Because
I believe so. I believe that unless there's a strong feeling or indication that the Fed is going to do that. I think that the long-term rates end up stopping around the overnight deposit rate. So if we look at like Switzerland, why does Switzerland have the lowest rates? Well, they have one of the lowest overnight deposit rate. They're down at negative 75 basis points. The German bunds are around negative 50, where their overnight rate is. Japan's 10-year is actually higher than Germany because their overnight rate, I think they moved it back to maybe 10 basis points. So when the curve gives up on the idea that the Fed is ever going to raise rates again for as long as time goes on, then I believe that the curve ends up just bunching up where overnight rates are.
Okay, so just pancakes.
Exactly.
And so at that point, it pancakes, and even though theoretically stocks are worth infinite because long rates are zero, it's actually the opposite occurs, is what you're arguing. We have a collapse in risk assets. Is that correct?
Because I think that the stock valuation is more tied to the real interest rate rather than the nominal interest rate.
Okay.
And I believe that the real interest rate will rise in that scenario, as we saw in March. Fortunately, I brought so many slides, I don't have a slide of the real interest rate. But if you look at what happened in March, the real interest rate spiked.
Right.
Almost 100 basis points in a couple of days, I think.
Listen, you don't have to tell me I have long break even, so I know all too well about that spike. Yes.
So I think that part of the reason we saw assets move higher and gold go crazy over the past couple of months is because when real interest rates spiked, then the Fed was able to come in and get those real interest rates under control, and we saw a huge decline in real inflation rates, which reflated everything. And I think a lot of the people that are really on the gold train, because of the fiscal and because of the MMT, were reminded that gold is a real interest rates trade. It's not a dollar debasement trade until the link to real rates breaks, which I don't think it will break as long as we're operating under this environment. But we've seen the dollar get so weak, but gold hasn't performed well since the summer because we've had a decline in real interest rates for a good reason, though. I would make the distinction that if you have an upturn in growth, like from 2016 to 2018, real interest rates rose pretty significantly, but stocks were able to absorb that rise in real interest rates because it was on the back of organic growth. When real interest rates rise because of deflation, then asset prices are subject to go down quite a bit.
Okay, so in this environment, how do you protect yourself if what you're worried about comes to fruition?
In terms of
like in the
deflation?
Obviously I can imagine that have a similar portfolio or a mix for the next year as we get this reflation, and I'm more interested in that next move, that next layer, kind of. Whereas a lot of people will be rushing out and wholesale changing their portfolios, I would take it that you would actually be going back to the deflation portfolio, owning more bonds as rates go back up. And I'm just wondering, what does a portfolio that you would look like under that scenario?
Sure. So I guess I'll talk about a little bit of my framework. So I have a simplistic framework. My home base is the all-weather portfolio, combination of stocks, bonds, gold, and commodities, equally weighted to all environments. Right. The way that I look at it is my exposure of risk. So I look at the volatility of the asset and whatnot. But basically, my home base is the all-weather portfolio. I believe that that's well suited if you have absolutely no idea what's coming.
Okay,
right?
Fair enough. Yeah.
And then I take that baseline, and based on the trends, both the long-term structural trends and the short-term leading indicators, I take those two trends and I shift the portfolio in the direction of the assets that I think are going to do well or away from the assets that I think are going to do poorly. So to your point, I obviously have had the all-weather plus overweight long-term bonds for quite a while. I've shifted underweight long-term bonds, overweight intermediate-term bonds during this reflation. But as soon as the leading indicators turn back over, I would go back to home base, all-weather, and then continue the shift back towards the assets that perform well in deflation.
So you really are a Lacey Hunt disciple. Your idea of getting defensive is moving from the long bond to the intermediate bond.
Well, because I look at everything relative to my baseline.
Yeah, okay. I'm just joking.
Yeah,
with you.
I know.
It's not like you like. It's not like you're
I
actually
moved from a
reducing.
28-year duration to a 25-year.
Yeah, that's right. You're a madman. Crazy stuff. Okay, so why don't you talk to what do you think will be the big surprise for investors over the next kind of, I don't know, 5 to 10 years?
Over the next 5 to 10 years, I think that the nonlinearity is what's going to trip people up. I think the nonlinearity of the decline in real GDP per capita, if we continue to pursue this path, if you go back to slide 5, I think that if the econometrics holds, this should accelerate. And it's hard to imagine this accelerates more than it does without it just going straight down off a cliff.
Right.
But the econometrics would suggest that this is the path that we're going to go on. So I think that what's going to surprise people is, nobody likes to really talk about it or admit it, but, we know that in the 90s trend, we had a long-term trend of maybe like 3% growth, and then it kind of dropped to in the mid twos. And then this last cycle, we were kind of complacent with the fact that our new trend growth is 2% real growth. What's going to surprise people this time, I think, is that after we have this reflexive bounce, every time there's a recession, there's a snapback. And the Zarnowitz rule tells us that the bigger the decline, the bigger the snapback.
Okay, wait, I don't know this rule. What is this one? How do I spell it?
Z.
Zar. Zed.
Let me type it into Google.
Zarnowitz.
Zarnowitz. Zarnowitz.
Oh, nice.
There you go, right?
So that is the more the
So-
rapid the downturn in economic activity and recession, the faster will be the subsequent recovery in activity.
Exactly. So how did we get, plus 3 million on jobs? It's because we had minus 20 million, right? Or how did we get a plus 33% GDP? It's because we had a minus 33% GDP.
Right.
So the bigger the decline, the bigger the snapback. So we're in the middle of this snapback, which I think which is unrelated to the cyclical upturn. So we've had the snapback. I think the snapback is for the most part over. We've seen job growth. We've seen most of the economic data start to normalize. So I think most of the snapback is done. We're still going to have some upward bias to some of the data because of the cyclical trends in the leading indicators. But what's going to happen is we're going to revert to trend potential pretty quickly. And I think that reversion to trend potential is not going to be the 2% that we were accustomed to last cycle. I think it's going to be probably sub 1.5%, maybe even sub 1% if we look at it on a per capita basis. And I think that's going to throw people for a loop when we have to start to grapple with the fact that, hey, our trend growth is really 1%, not 2, not 3, not 2.5. And then the prospects of raising interest rates to 2, 3, 4% when your trend growth is 1 starts to lose all plausibility. And then you get into a scenario where the market says, oh boy, we're really never going to raise interest rates ever again, maybe. And then the curve bunches to zero.
And then,
so I think,
sorry, I didn't mean to interrupt, but if, in that scenario, doesn't your problem about the haves and the have-nots get all the worse? And doesn't that just accelerate to some sort of social upheaval type situation?
I agree. I took the question as a markets question, and as a social question, I think you are spot on. I think that this is going to accelerate to the downside in terms of real GDP per capita. If I don't know if you guys have the ability to jump on Twitter right now, but Cornerstone Macro, Roberto from Cornerstone Macro took my chart from this morning of real GDP. Nominal GDP, the chart number 3. He took that chart and he overlaid the amount of wealth that the 10% owns, I believe, is what the chart showed, inverted. And it was a mirror image of this chart, meaning that the lower that this GDP rate goes, the more wealth is concentrated in the upper 10%, likely as a result of the lower that nominal GDP goes, the lower interest rates go, and that disproportionately benefits asset holders. So I totally agree with what you said.
Okay, well, that's kind of a crappy note to end it on. So let's talk about something else. We were talking, shooting the shit before the show, and you were saying that you were a hockey player, and Patrick and I, our ears perked up.
Love it.
You know what? Even though you grew up in the city, New York City, I was like a hockey player. Why don't you tell us a little bit about your hockey career?
Yeah, so I played hockey as long as I can remember. I think I started skating maybe 4 years old, something like that. Played all throughout my childhood. We played a lot in Canada. Played in Toronto. Ended up playing juniors at Applecore in Long Island, and then had the decision to make of, do I try and make a run and play at a D1 or D3 school, which you guys know in the hockey. Well, you guys have the Q and stuff like that over there. So in U.S. Hockey players as a freshman, usually they like you at 20, 21 years old. So I decided to pivot and go the school route versus playing a couple more years of juniors. But it was a huge part of my life for pretty much every year up until 20.
So Eric, I'm as old as dirt, so I actually don't know what university schools are now. They want you to play a couple of years of juniors and come in bigger, more mature, and stronger before you come to the university team.
I think it may have changed since I was playing juniors, but when I was playing juniors, I guess 10 years ago, the average age of a college freshman was about 20 and a half. So they really wanted you to graduate, play 2 or 3 years of juniors.
But isn't juniors considered pro? And I thought you couldn't play pro if you were going to go to the college.
Not in the United States.
Oh, they changed that. They must have changed that.
Yeah. So not in the United States. I mean, if you go to Canada, so a lot of players that I played with, did what you said, and they went to Canada to play juniors in Canada, which is considered professional, and then I believe you lose your ability to go play in college after that.
Yeah.
So going to play in Canada is a bit of a gamble, because your entry to the pros is a lot higher. I mean, you got a much better shot at making it coming out of one of the leagues in Canada. But if it doesn't pan out, you lose your opportunity to play in college.
But if you're coming from the States, chances are you have all your teeth and you're going to do really well in Flin Flon, Manitoba when you're playing hockey.
Yeah, I remember the first time that we went up to Canada, must have been I was 12 or 13 years old, and we got the crap kicked out of us so bad. We went to the locker room and we were like, I thought the people we were playing against were 30. But I think, it was.
Yeah, I have a good buddy. Well, actually, he passed away, but he used to work on our trading desk, and he tells the story of he played junior hockey, and he was playing. He was a good hockey player, and he was 16 or 17 years old, and he said, "Oh yeah, I played against Wayne Gretzky. I was 17, he was 12, and he missed like 22-3 and scored 18 goals, but I played against Wayne Gretzky." So,
well, funny story. Jack Eichel on Buffalo.
On Buffalo. Yeah.
Patrick seems to know him, so I'm not very up to date on hockey. But anyway, so he's
drafted him in my hockey pool.
Did you grow up with him?
I played against him for a number of years. He played on the Junior Bruins in Boston, and I was playing at the time. I was probably playing with mostly 20, 21-year-olds, and I was 17 or 18. I think most of the players were about 20. And we always played against Eichel. And oh boy, where's Eichel today? And he would put up like 6 points or something like that. And he was like 14. It's like, I couldn't believe how when I looked at the roster, I was like, this guy's 3 years younger than me, and I'm 3 years younger than everybody else.
Okay, so one last thing I'm going to leave you with. You're too young for me to ask you what you would do if you were talking to the younger Eric. But I will ask you this. You've been around the finance industry. You've worked in a hedge fund. If you were to give like a little brother or someone that was interested in coming into the industry kind of a piece of advice, what advice would you give them?
What advice would I give someone coming into the industry is that you have to have, taking it from an investment standpoint, the thing that I believe is critical is you have to have a strategy or a baseline that you always go back to. I think what a lot of people do is they approach the markets without a set strategy of, I'm long today, I'm short tomorrow, I'm long because of X, Y, Z, I'm short because of these reasons over here, and they don't have a set framework to always revert to, and it's a little bit like they flow with the wind. So I think that you don't have to spend too much time creating the perfect black box or the perfect strategy, but I think that at least the younger people would be best served to pick some long-term strategy that you can live with. Give yourself some room around the edges to play around if that's what you enjoy, but give yourself a baseline to stick to so that you always have a strong foundation when times get tough, because there will be periods when your favorite asset goes against you, and you have to have a strong framework on which to revert to. And also it gives you staying power, the ability to stay with the long-term bonds, even though we have a reflation, because I have the framework of a more balanced portfolio. Had I been just a straight bond investor and put 100% of my money in long-term bonds, the downturns would become intolerable. Well, so I think that the strong foundation for anybody is critical. And I think that a lot of errors are made when people start to drift around without having a solid framework.
That's a great piece of advice. And Eric, don't worry, you got the medium term, so you're going to be fine in this inflation. So Eric, why don't you tell people where they can find more about your great product and how they can get in contact with you?
Sure. So if you go all the way to the last decade, I have a shameless plug. All my contact information. EPB Macro Research is the website. You can find me on Twitter. Very active on Twitter. I throw up a couple of YouTube videos every now and then, and mainly I publish my work on Seeking Alpha. That's where my premium research is. I also publish a ton of free work on Seeking Alpha as well.
So you know what? Let's do this again a little bit slower because you went fast. So it's E as in Edward, P as in Paul, B as in Bob, macroresearch.com, right?
That's right. EPBmacroresearch.com.
Yeah, and it's the Twitter is EPB Research, and all the other good stuff, YouTube and Seeking Alpha. And
all EPB Macro
And
Research.
Don't worry, we'll make sure that we get the correct slide in there for you at the end.
No worries.
Eric, it's been a pleasure having you. You've given me a lot to think about. Who knows? I might even go and cover some of my bond shorts tomorrow. Thanks for joining us today.
Not until the reflation's over.
Okay.
Thanks so much for having me, guys. I appreciate it.
Yeah.
Take care.
Thanks a lot, Eric.
Okay, folks, it's that time of year again when Kuppy's back. We missed him last month. Harris, thanks for joining us.
Hey, guys. How's it going?
Good. It's
good,
listen, lots to talk about since we've last spoken. We missed you last month, so it's been 2 months. When you left us last, you were at the forefront of getting ahead of what you call the crypto fraud or crypto Ponzi's, whatever you call them. I kind of laugh.
Of all time.
Yeah, I kind of laugh because you tell me that you managed to piss off your regular value kind of guys that listen to you because you're buying good stocks at cheap prices, and then you managed to piss off the crypto guys because you're calling it a fraud. So basically, you just piss everyone off, which I think is hilarious. You got the call right. You bought all these stocks. They've exploded higher. Why don't you give us an update on what you're thinking there? Are you still in these? Does it have more to go?
So let's start with Bitcoin itself, because I mean that is what's driving everything, and it's really this thing called Grayscale Bitcoin Trust, which is hoovering up all the Bitcoins out there. And I wrote an article about this about a week or two ago that because it trades at a premium, people keep putting this funny arbitrage on, and there's a trillion ways to put this arbitrage on. You know, after I wrote that article, and one of the reasons I write articles is people always email me interesting stuff afterwards. You know, I learned about 10 new ways to put this on with swaps and OTC. There's just so many different ways to put it on, but everyone's trying to capture this 20 to 30% spread. And to do that, you have to be long Grayscale at NAV. So you have to buy it in the daily offering, which means Grayscale has to buy more Bitcoin, which keeps pushing Bitcoin up. And that's all you have to know to how this thing works. You know, Bitcoin goes up because Grayscale buys it.
Right.
And
well, actually, Harris, 1 second. Can I jump in here? Why don't we explain to people what the ARB is, just in its simplest terms, so people can understand? Like the Grayscale Trust, what is the symbol?
GBTC.
That's right. Yeah. So it is kind of the go-to ETF that holds Bitcoin. And unlike other ETFs that are constantly issuing and creating and redeeming baskets versus the underlying, it doesn't work this way with GBTC. Why don't you tell us how it works when you want to create new GBTC shares?
So if you want to buy new GBTC shares, you go to there's a place you can click on their website. Sales guy calls you within about 3 seconds because they're very well incentivized to sell you products. Um, and there's a form you fill out, and you get to buy it at net asset value. Right. And so Grayscale itself trades at it's been about a 20% average premium to net asset value all year long. Though the premium, it goes up and down a lot. It's a kind of funny sine curve. But anyway, what happens?
One second. There's a kind of a catch in that you get to buy it at net asset value, but you're not buying freely trading stock.
Right. Oh, now we're getting into legal. I mean, do you want to talk about the history of the 144? Always go the 44 Act.
No, but people have to understand, because if they were issuing freely traded stock, the arbitrage would close immediately. But the reality is that you're buying private placement stock that has to season for 6 months before it becomes freely tradable. So when it's trading at a 20% premium to NAV, and you go to buy it today, you are getting issued stock, but you can't sell that in the open marketplace until 6 months from now. And that is, in essence, why the arbitrage between NAV is not closing. Correct?
Correct. So you get non-free trading stock. You have to wait 6 months. And so everyone's buying this at net asset value, and what they want to do is hedge. And so you could basically borrow the stock from your prime, and you can short it, and you can lock in 20% for 6 months, which works out to north of 40% even after borrow costs. In an interest-free world, that's one of the greatest returns I've ever heard of, and a lot of people are putting that trade on. You can go out there and put a basis trade on, where you're saying, I don't have a broker that'll lend me this, but I'm going to short Bitcoin futures. And what I'm doing there is locking in the Bitcoin. And I'm taking the risk that there is going to be at least a marginal premium to net asset value 6 months from today. You can go in there and not hedge it at all and just recycle, in which case you're going to buy it at NAV. You're going to sell it 6 months in a day, and you're going to buy it again at NAV. And if it's a 20% discount to NAV, you get 20% more shares. There's a lot of ways you could do this. You could borrow Bitcoins themselves and hedge it. There's so many ways you could do this. But there is an arbitrage there. It's a wide arbitrage. And what's really rare is that this arbitrage trades in the billions of dollars a day. Sorry, no, in hundreds of millions a day. And it's just bizarre to see something so wide and so available to be arbitraged. And all the biggest players keep doing it. Is that a good enough summary?
It's great. Yeah. It's terrific. And so they're just going in, and the Bitcoin Trust is hoovering up all of the Bitcoins because they keep issuing more shares and buying all the Bitcoins. And I think in your article, you talked about how much of the newly mined Bitcoin is purely going into ETFs, and it's an astonishing number.
It's GBTC is doing 2 to 3 million shares a day on average. There's some days where it does a lot more, but you're talking about 2,000 to 3,000 Bitcoins a day, and Bitcoin's only producing 900 a day. Yeah. So it's not just the incremental daily creation. It's actually tightening the float, and it's tightening the float at a few basis points a day. And a few basis points doesn't sound like much, but a lot of the free float is owned by retail individuals. It's owned by other guys. I mean, these guys aren't looking to sell. And then you have a bunch of these other vehicles. Every country has one of these things. I call it the QSIPs. There's about 20 of these on a spreadsheet I'm tracking. And pretty much every day they do some sort of offering and buy more. And it's just artificially pushing Bitcoin higher.
And so it's artificially pushing Bitcoin higher, and we're getting a squeeze of epic proportion. And so how were you playing it?
Oh, I was kind of the patsy just buying a Grayscale Bitcoin Trust. I'm not being very sophisticated. I'm not a very sophisticated sort of guy, honestly.
You had some names that you liked when you were on our show. I think you were talking Mara and Riot at one point as well.
Oh, the Ponzi. Oh, the crypto frauds. I thought you were talking. So what I did was I took a successfful Ponzi scheme, and a Ponzi scheme is just a subcategory of fraud. Actually, most security frauds are actually subcategories of Ponzi schemes, as Jano says. But what I was doing was I was taking a very levered derivative fraud on top of a Ponzi scheme fraud. So I was long on these two companies. One's called Mara, one's called Riot. They're fraudulent entities. They're both created by Barry Honig, who's kind of like the Babe Ruth of securities fraud. Instead of going to jail, he got a lifetime achievement award from the SEC. He was just that good at it. And so anyway, I was playing these, and they moonshot it. Riot was like a 3-4 bagger. Mara, I mean, I bought mine at like 90 cents. It's $6 today. I'm all out of these now. I sold too soon, like I always do. I don't want to speculate too much in fraud, and I played them super small. Don't think we're becoming a fraud fund like everyone else. We still own value stocks, but if you see a Ponzi scheme inflating, you're supposed to play it, or I guess that's what I've been told.
Is that an offshoot of Soros' theory?
I think that's a direct quote.
Okay, so what do you think's happening with the crypto? Are we?
It's going much higher.
Oh, you think so? Eh? Like we're just early innings.
Early innings. I mean, look, we're at that still phase where all my drinking buddies are telling you it's the wrong thing to own, and it's weird. The last two cycles the first cycle was tech guys. Computer guys, people who understood it and had sort of value in it. The second cycle was more, U.S. and Asian retail that just bought something that was going up. This cycle is odd in that it's mostly like hedge funds.
Yeah.
And I don't know if that makes it healthy or unhealthy. It's probably unhealthy, to have a bunch of hedge funds clustering into this thing. But I tend to think it goes higher. In the end, the free float's just getting squeezed. And if we get above 20,000, which it looks like we're about to, I think all the FOMO guys come back in. Plus, you got your PayPals and your Squares and everyone else, buying $100 at a time. And there's a lot of people who want $100 worth. I just think it goes much higher. And I own Grayscale. I bought it at about a 7-8% premium to NAV. People laughed at me at the time, but here we are at 20% premium. I would say to people, though, that when you look at Grayscale throughout the history of the product, it's often traded at very wide premiums to NAV. And so I have no problem with paying a premium to NAV because that premium to NAV can expand. It could also actually trade at a discount to NAV. But if you're bullish Bitcoin, the premium probably expands. And then I own a little bit of this Canadian piece of shit. I don't think it's actually a fraud. I think it's just kind of a clusterfuck and poorly managed, which is what
typical
Canada,
for a Canadian.
Right?
It's Canadian company, right?
Yeah. I own some of this Hut. Mining Bitcoin is a terrible capital destructive business. It's actually probably worse than mining for gold. But they own a lot of Bitcoin too, and it's all going to go up. And if the other frauds are going up and these guys are honest, I mean, obviously there's less alpha there because fraud equals alpha. but it'll probably go up with the rest of them. I don't know. I paid about $1.25 for mine, and it's $1.75 today, so I don't feel so bad about my decision.
Okay, so there we hear Bitcoin is headed higher according to Kuppy. So let's go on to the next thing that everyone's talking about, which is EV, electric vehicles. First of all, when Tesla got announced that they were going to get,
are you still short that thing?
Yes, I am. they're just gonna like I'm just gonna be on my tombstone. I'm me and Mark Spiegel. Anyways, I still think that the getting announced into the index was a sign. But you know what I missed, and I'll be honest, I missed how many active people would view this as kind of the all clear to get long EV in general. Because I don't think it was actually as much the Tesla going up as the whole sector going up. They all ripped on the news, right?
It's stunning. I mean, some of these things, like Solo, Aero, FUV. I mean, I drove a FUV, like the 3-car one.
Yeah.
Like, it was such a piece of shit. I thought I was going to die just going in a circle in the parking lot. I mean, thank God I didn't short it at $2. Like, I literally got out of the car and said, this is a short. Like, these guys are going to blow. They're going to pump it for 2 weeks on like Motley Fool or something. They're going to blow out of all their stock. We'll never hear about these idiots again. They've done like 4 capital raises and it keeps going up. Like, literally every time they raise money, it goes higher. That's not how it's supposed to work.
It's absolutely stunning, isn't it?
So I'm on my Bloomberg. They did a raise. They did 2 different raises in the month of November, and the stock is still up. Like, they literally dumped as much stock as they could on unsuspecting idiots, and the idiots are like, "Give me more. I just need more."
I think it's one of the strongest bull markets that I've ever seen. It's reminiscent of '99. I almost think it's in some ways it's even bigger because we didn't have something going into the index so quickly in such a big kind of high fashion, right? In 99.
Do you remember when Yahoo got added and Yahoo just was like, I think it was like $100 stock and it ended up like $400 or $500 because the index just had to buy it all and there was really no float. Do you remember when that got added to the S&P 500?
I don't remember that one.
Oh, you should look that up. No, I got added to the S&P 500 and it went crazy. I remember when JDSU got added.
Oh, I remember that one.
And that went parabolic too. I don't know. Look, the day they announced it, you went short. It gapped up like $50-$60, whatever. And it pulled back like $20 and I went long. And I took it home overnight. I told you I took it home. And I'm like, I can't believe I own Tesla. I woke up in the morning. I didn't have that much. I had like 5,000 shares or something. I woke up in the morning like, I can't believe I own this thing. Then I was up like $50 more. And I was like, okay, fine. I made some money.
You nailed it. You took my money from me. Well done. So let's talk about other ways you're playing it, because there's lots of opportunities. A lot of these EV names are actually in the SPAC world, and they're getting floated that way. And I know you and I are both kind of partial to trading these warrants, because every SPAC usually comes with a warrant. The trouble is these things are landmines. So let's go through some of them. Let's talk about what you're doing there and what people might want to look and check out if they're interested in playing this game with us.
Yeah, sure. I mean, I guess let's start by saying that this is for professionals only, because even the professionals get this wrong. I got QS wrong 2 days ago, so fair disclosure. But basically what happens is you get, when you do a SPAC at the IPO, you get shares and you get warrants. And the warrants are kind of the same in that they're all at 11.5 strike. Yeah. But then from there, they get very different. And you have to go deep into the warrant indenture to figure out all the rules, because these things are designed to screw people.
You could say that again.
They are landmines like you wouldn't believe. All full of landmines. They're all full of ways for the sponsor to screw you. And the sponsors have just been going around screwing everyone, which is part of why there's a spread in the first place. Most guys just don't want to read the document and figure it out. The other reason for the spread, in my mind, is Robinhood doesn't let these warrants trade. And so everyone chases the equity side. So you end up with this funny situation where you have a $30 stock and there's a $10 spread, which is, amazing. And the deal usually closes 30 to 60 days later. So your IRRs are well above 100% if you put these things on and you don't make any mistakes. That said, there's a lot of mistakes to be made. And, I made a bad mistake in this QS. It cost me some money. So just saying, it's risky, but there's a lot of opportunity.
It's fascinating because you have these warrants that are theoretically, like if they were just regular warrants, they should at least trade at intrinsic because you should be able to exercise them. But because they don't trade they're not exercisable, they end up trading at wicked discounts. So, you pull up a stock, it's $30. The warrant strike is $11.5. So if I do my math right, the warrant should be $18.5. But the trouble is it's trading at like $8 or $9. So you have these $10 spreads, and the scary part about it is, Harrison, you're let's just say more bullishly inclined than me. When you do it, you often are a little bit hedged to the long side, whereas I'll put it on 1 for 1. So as it goes up and as that stock goes from $30 to $40 to $50, as this kind of madness continues, the spread blows out more and more and more. And it is an interesting way, though, of playing from the short side. Would you not agree? Because as they come in, back to the Hylon or HYLN, as this came in, it actually naturally, the spread compressed even without the actual technical reasons that the warrants are become exercisable. That wasn't the trigger. The trigger was the stock coming in.
Right. I mean, and I've seen a bunch of these trade, and everyone is a little quirky and different, but big picture, as they go up, the spreads get wider. As the share price goes down, the spread collapses. And then eventually, you have full convergence when the prospectus gets filed and becomes effective. But, you're taking a lot of risk because, if this thing goes to 100 and, Nikola buried people who put this trade on, which is part of why there's a spread, you got to be, able to stomach the pain. Why I'm not playing any of these too big. And I'm usually doing them in a ratio where I'm a bit extra long the warrants, so I have some coverage to the upside, though I'm taking a little bit of risk to the downside. But there's just so many ways to play these, and there's so many weird arbitrages. If you look at the Tontine, for instance,
what's the symbol there?
PSTH.
Oh yeah, okay, that's
AXPAC.
Yeah, AXPAC, but that's Bill Ackman's PAC. Okay, yeah.
You haven't heard AXPAC?
No, I haven't heard AXPAC. So
he should have named it AXPAC. Anyway. You have this thing where the SPAC is trading at 26 right now, and the warrant's trading 9.5.
Yeah.
The warrant.
Well, one second, I'm gonna interrupt here. Bill Ackman couldn't be like everyone else. He didn't do his at 10. He did his at 20 or 25. I can't remember.
He did it at 20.
Yeah, fair enough. At 20, that's right. So it's double as good because it's $20.
Yes. It's every one of these is a little quirky. He didn't give you a half warrant like everyone else. You got 1/9 of a warrant. It's all a little odd.
Yeah.
But what's odd about this one is that retail just loves Bill Ackman. And so instead of buying the common, this is the only one where the warrant trades at a premium. The warrant's 9.5, and it's a 23 exercise price. It's double 11.5. And so the warrant is trading really wide of intrinsic right here because the warrant has a cap at 13. The warrant can never trade above 13, which means that at most the share price can go to 36. So you have this capped call, which really, because the shares are up a bunch, it's odd. It's the one where the warrant's at a premium and you can short the warrant and buy stock. Or there's so many different ways to put this on. And I like to say in finance, there's a lot of ways to make sausage, and everyone has their own recipe. And there's just so many ways to make money at this, but there's so many ways to lose money too.
Yeah.
And so you still have this QS on, right?
Yep. I'm not as worried about it as you are, but let's talk about what the issues are there, because one of the keys is that they have the typical warrant becomes exercisable when the deal is closed or 30 days after the deal. But there's also a little bit of let's just say, seasoning period, and often they have to go a year before they're exercisable. Now, some of these SPACs, they've been trading for a long time, so that's not an issue. The thing is, QS is a relatively new SPAC, so when you buy that, even if they go and they close the deal and get it done, you're still, those warrants are not going to be exercisable until a year goes by. And so that was the issue. You say you got hurt on that, and that's the issue there. Having said that, I kind of you always assume they're going to be more nefarious than they actually are. It's funny because when you and I chat about these things, you're always assuming that they're out to screw you and take every single dime they can out of you. And I always say, no, sometimes they don't want to do that. They just want to get, they just want to make an efficient market. Like, what was the one where we thought that they would do cashless and they didn't? Was that Nikola?
That was Hyliion.
It was Hyliion. Okay. There was one that was...
But Hyliion has no cash. Keep that in mind. I mean, the whole point of the business is to put cash into the shell so they can steal the money and salaries. So they'd be stupid to give it to the arbitragers.
That's right. Anyways, I still have it on. You've taken it off. I kind of view these more as a portfolio approach. To me, it's a way of playing the EV kind of from this bubble perspective, in that it's going to crack. Because, let's face it, a lot of these stocks, as you mentioned, that won the FUV, are just garbage and are going up in terms of valuations that make absolutely no sense. So I'm looking for, ways to play it from the short side with an edge that hopefully don't hurt too much. Now,
right. And, the thing with FUV or any of these, you can get the borrow called away. You could sell calls and then they exercise those, and then you get a borrow, you get called away. There's a lot of ways to get hurt shorting these. And that's not to say that FUV doesn't go to 200 before it goes to 0. So being hedged in this, roughly delta hedged, it could go up, it can go down, but as it goes down, you basically converge. And then there's a stop point where it does converge because the deal closes. So you don't have unlimited risk like Tesla.
Yeah. No, and I agree. Yeah. And not only that, a lot of these companies are actually a lot worse than Tesla. These is true garbage, some of the stuff that's rallying here. Question I have to you is, was that the top the other day when we had one of these days? I can't remember which day it was, but they opened on their highs and they were immediately sold. And a lot of these things were off. And was that the top? Was that the classic, just get me in that ends up marking the high of this move?
Well, it was a top. I mean, they're still melting and bleeding red today. I don't know. I mean, I've called a top about 10 times in this stuff, and it just kind of sits there for a few weeks and keeps going. And
yeah,
I don't really know. I mean, I have a few of these on the warrant arbs, and They have committed conversion. I have this SBE. I put it on like $15 wide for a $40 stock, and here we are as a $30 stock, and it's like $9 wide. So like, it's coming in 5 points. Like, I'm just saying you could trade these and make money on these, but I have no idea. I don't know.
Yeah, I have that SBE as well. I think that's another good one. Well, here's another question for you: is that a lot of these are in SPACs. And you talk about how, we go away, it gets quiet for a couple of months, and then all of a sudden they come back to life. I've been shocked at the fact that the SPACs have come back to life like they have. Like, I don't know, how do you feel about that? I thought the game was over.
I thought it was over too, but I have a list of these where, they haven't even announced a deal and they're trading 30, 40% premium to the cash basket. Like, you don't even know what bad deal they're going to do, and people are just saying, get me more of this.
It has been the most unbelievable arb, in the hedge fund community. And it's been shocking for that it actually hasn't been chased more than it has. And I guess maybe this is them chasing it now, because the reality is that because of the fact that the hedge funds can put it back at $10, these portfolios of these things have been one of the best risk-adjusted strategies out there, bar none. Nothing beats these things.
Nothing. And remember, the funds that put this on, ignore Baupost, but they tend to be funds that are looking to make 7-8% a year, and they buy it in the unit and they peel it off, and they sell the warrants and they put it back. Yeah. And it's been a very consistent mid-single digit strategy. A lot of these funds are up like 100% this year.
Yeah, they're making that in a month.
But they're supposed to make like 7 in a year.
Yeah.
It's stunning.
Yeah.
The great thing about finance is that, if people have demand for a product, they'll create more product. There are so many of these SPACs now that have been launched, and every day every week there's about 10 or 15 new IPOs. Eventually they're just going to bury the market in this stuff. Kevin, you and I were joking that I can't keep track of which one's which anymore because I have so many of these on my screen.
That's right. Let's just talk though about this, because I think there's got to be ramifications about the fact that these SPACs are doing so well. And at first it seems like, it's everybody's winning. It's win-win-win across the board. And whenever I see that, I think to myself, no, somebody's losing somewhere. And so my theory on this is that really who's losing are the people that are getting stuffed with bad businesses when it's trading around the strike price, meaning that so if you're going out and you're buying a company and you're paying $400 million and the market's saying, it's worth roughly $400 million. But the reality is that the SPAC is trading right at that point where they can put it back to the company, meaning that the hedges, the arbitrageurs are there buying it. Then the people that are going to be left with the on the other side of the SPAC are in essence paying too much because they're getting fooled into believing that the company they're buying is actually worth that. And I've seen these, and when we originally started talking about this, you and I, way back when, you used to say once the put's gone, these things collapse. They go down to like $2-3, right? And that was for a long time the play in these things was to trade it afterwards after the put was gone. I'm wondering if eventually the kind of the popularity of these things will make that the true trade out there to basically short them once the put's gone.
I think every one of these that hits $9.99, you can put it on in a basket approach. It's probably the best beta hedge to your portfolio. You put a stop, a buy stop in at 10.25 and just let them melt away.
After the put's gone. After the put's gone.
Yeah.
You have to understand that when the put's gone, when the put's there, it's completely, that thing is like a T-bill. And it's the real key is that once the put's gone, that's what happens.
Nice.
Yes, but I haven't seen a sector with this much alpha because you can't computerize this. You can't track them. There's just too many of them. I have spreadsheet upon spreadsheet keeping track of all these stupid things. And then the tickers change when they do a deal.
It's wild, isn't it?
What was it?
They change multiple times too. They change when they get a new when they finally do a deal, but they also change when they split and they just and they turn them from W to WS. It's just like
and the U disappears. Yeah. So none of my spreadsheets line up anymore. And then I have this problem. It's so which SPAC was QS? Is that KCAC? Was it KT? Whatever. And then you have to go into the warrant indenture to figure out what the rules are. There's just so much alpha here. I'm surprised I've done so much SPAC ARB lately because I'm kind of neutral in the market and I'm degrossing effectively. I'm I'm more than 20% cash, which is rare for me. But I feel like I'm pretty well hedged in these, and I don't play anyone too big. But I've put a lot of these on over time.
It's fun. It's a very, for the kind
Fun.
of professional.
I like that word.
Yeah, it's fun for the professional trader. It is a lot of opportunities and a lot of different things happening. I do feel a little bit like, when the person, like when a magician tries to trick you with all sorts of things going on, and there's lots of movements and stuff. That's how SPACs feel to me. But if you keep your eye on the ball, you might figure out which cup that ball is under. So listen, one of the things, I know Patrick wants to jump in. Patrick wants to talk some coal. So Patrick, you take over, bud.
Oh, for sure. No, like Harris, I know you were on a couple of months ago, and we were talking about Peabody, and there was another one that you were talking about was this Alliance Resource Partners, the ARLP. What's your take on the fact that they've started moving? I mean, a lot of them have moved higher. Do these things have more upside in your mind?
I think as a basket they do. In the end, there's been really no capital investment in coal in a decade, and you're not going to get a new coal mine permitted anywhere, and the world still needs coal. I mean, even thermal we need. I mean, Alliance that you're talking about, it's like 1.5 times cash flow with a good balance sheet. That just seems too cheap in this world, especially, the insiders own a lot, and it just seems too cheap. Some of the other ones, Centerra, and there's a couple in Australia that are doing quite well. The coke and coal world is coming back too. You need that if you're ever going to have an infrastructure program. So I think we're going to see pricing recover in the end markets, and then that'll drive the share prices higher. Peabody might not make it to the other side, but that's why you play this in a basket.
Right, and that's interesting because Peabody was trading down to hit 80 cents on the downside. This thing is just nonstop bleeding. It seems to fade every single rally here. This is the dog shit of the group, is it?
Yeah, I think the technical word is insolvent.
Okay, but don't get too much into technicals, but
it could. So they have an issue in that they have covenant breaches, and they have a bonding, and the guys who are bonding them are saying unless the bondholders roll the bonds forward, they're going to pull the bonding, and then the whole thing collapses. So it's kind of a game with different creditor classes all bluffing each other. I think that everyone loses in a bankruptcy, so the incentive for everyone is to kind of bluff it forward and see if in 6 months it all coal pricing recovers and there's a business here. But then you have Elliott owning a bunch of stock, and who knows which side of the play they're on. They're always probably playing 7 angles.
Right. Because that's the big thing. Like Elliott has a big position, and it's like, what's his angle on this in terms of what is he looking for recovery? Is he trying to restructure it? That's a good question, right?
Yeah, I don't know. That's why we play these in baskets. But yeah, I do think that as the global economy opens up after COVID, I think you're going to see coal pricing pick up because there really just hasn't been much new supply, and the demand is going to pop back. I mean, in China, it already has popped back.
Right.
Okay, so I'm going to Patrick. Can I ask a question?
Yeah.
Okay, so I'm going to jump in here. Last time you chatted with us, the buzzword of the day was degross, and I heard you say it again. You're still degrossed, and most people are sitting there looking at it and saying that the election's over, all of it, the vaccine's on its way, everything is basically coming into becoming more certain. But you're not as certain. What are you thinking these days, Kuppy?
So I'm sure I'm going to regret saying this, but I just don't think the election's over. That doesn't mean that Trump's going to win. I mean, I don't know what's going to happen. I just think that in America, you have an odd process of confirming the vote, and all you really need is a couple of renegade legislatures in any one state or a few judges. You just need a couple people to say, hey, wait a second, I have questions about this voting process, and it puts the whole thing into limbo. And, markets hate limbo, markets hate uncertainty. I could see something really bad happening. In the end, the market desperately is hoping for stimulus here. And if you have election uncertainty, there's definitely no stimulus. And I could just see it going very bad. And the great thing about the stock market is that the vast majority of the time there's nothing to do. And I sit on my hands and do nothing. And I have my core book, but I'm just waiting for layups. And I like having extra cash. And then sometimes there's something to do and I get fully invested. And other times there's nothing to do and I say I'm going on vacation. And I actually have the most cash I've had in a long time because if something bad happens, I want to buy the dip. And Look, I've had an amazingly good year. It's been the best year I've had since 2017. And so there's really no reason to press it in December. I'd rather just go enjoy my holiday.
Right. Which is in true Kuppy style. You're doing it again. We're actually taping this early. We've taped this on Tuesday because Kuppy is gone. Are you willing to share where you're going?
Yeah, sure. I'm going on Thursday to the Azores. Actually, I'm hoping to go to the Azores. They keep changing the rules on COVID. I assume that I'll be able to get in. Watch me get trapped there and I can't leave. But we're going to go get our testing done and hope I don't have any COVID. My wife, I don't know about. And then we're going to go. And then from there, I think we're going to head off to Madeira and if we can to the Canary Islands. I don't know why I want to go see a bunch of islands so badly, but we looked at a map of what's open for Americans, and I guess the world really hates us. We're not allowed to go damn near anywhere. I mean, there's like 3 islands in the Caribbean, and then for whatever reason, Costa Rica says, you're all welcome. And so it's odd. Madeira and the Azores, they're owned by Portugal, but I'm not allowed to go to Portugal, which is the damnedest, weirdest thing. But I'm allowed to go to their islands. I guess they just don't care about those islands. It's like they're Puerto Rico or something.
I don't think they technically own them, quote unquote. But anyways, that's fine.
No, they are. I don't know. They have a special legal structure. But anyway, I'm allowed to go there. I just can't transfer through Lisbon. I found a flight that's direct from Boston. Okay. So I'm off to the Azores. If anyone lives in the Azores or Madeira that's listening to this, and I'm happy to buy you a drink.
Well,
nice.
Reach out.
Have a great time. We're going to miss you. Enjoy
Yep.
it. We're looking forward to seeing the new pictures of whatever you're drinking or eating. We always enjoy those. Thanks for your time. We really appreciate it. Have a great we won't see you till the new year. So thanks for being a part of the Market Huddle, and we'll see you in the new year.
Awesome, guys. Hey, enjoy your holidays as well, and let's chat in January.
All right. Have a good one, bud.
Okay, Patrick, time for Talking Charts. What do you have for us this week?
Okay, let's first review the top 3 things we were watching last week. We asked if Bitcoin, the crack in it, does it finally lead to a gold rally? Well, I don't know. What do you think? I mean, certainly Bitcoin did feel a little toppy. It certainly ran out of steam throughout much of the week, giving back almost every rally attempt. And gold is off of its worst levels, but yet not beaten some key technical levels. I think we have to be north of 1850.
Yeah, but Patrick, the whole week was up. The whole week was up.
Whole week was up on gold, and Bitcoin's been struggling.
I think that actually was a top things to watch that actually worked, Patrick. I'm proud of us.
That was weird. Anyway, so the EV correction, is it going to take down the whole market? Well, EV has continued to correct.
Well,
but
it corrects for about 4 hours in the morning, and then it just rallies back up. So I'm not really sure you're correct.
Well, I mean, I was looking at NEO, which continues to, let's say, weaken. Which one do you kind of track it by?
There's a whole bunch of them. First of all, the big granddaddy of them all, Tesla, went out on the highs.
Yeah.
So
that's yeah, but I mean, it is still trading at the same level it was a week ago.
Anyways, that was a dud one. It didn't really happen. I don't think it pulled down the market. I don't think.
It didn't really start to correct. So the thing is it has to be shitting the bed in order for bring down the market, and that hasn't happened yet, right?
Okay. What was our third one?
Third one was commodities and commodity currency breakout, and yes. I mean, obviously, grains and other things like that haven't really been pulling out, but crude oil continues up, $46. We saw intraday hitting almost I think the high here was 46.68 today. So oil keeps edging higher, but those commodity-based currency like the CAD, what a rip!
Yeah, I love it.
Love it. It's happening. And another one that worked. We're 2 out of 3.
Yeah, the best ever. Okay, so what do we got for next week? What are we watching?
Well, next week, the one thing I wanted to watch was whether the VIX was going to give out the 20 level. Realized vol continues to contract, and that usually is something that leads to breakdowns. And right now, we continue to hover at since the coronavirus crash. We are now at levels lower than we've seen at most points. I mean, in August we were down here, but will we finally see the VIX break below the 20 handle and get back into the teens? I'm watching. I think it's an interesting thing to watch.
I think the other thing that will be interesting to watch on that, Patrick, is does a collapse in the VIX cause that Vanna buying that causes the dealers that have to basically bring back some futures because volatility's gone down. They'll be buying back. Do we get a screaming rally that feeds upon itself?
I say yes. You know what? I actually, while the sentiment is there for it to begin to crash, like the sentiment is so very bullish, but I think that we may first go higher for the next couple of weeks before. I really like that narrative that the vaccine rollouts toward the option expiration in the middle of December might be a much more interesting date to circle for a turn in the markets. And I think until then, we might go higher first.
That's an interesting concept. So we rally into expiry, and then that's the turn. Good idea.
And then that's the thing. So number 2, nat gas bottom, and I know that I don't think you've been buying recently, but
no, I'm too underwater on my existing positions to add to it at this point.
Exactly.
Oh my God, that's an ugly chart. I didn't realize how bad it was.
Yeah, this is the Jan contract. And what's interesting is that when you look at it from the continuous nat gas contract, it just looks like a Fibonacci retrace.
Well, the other thing is, Patrick, I own the whole strip. So I think that there is no doubt, like we've had some really warm weather, and it's caused the front month to go no bid and get collapsed. But if you look at, I'm just going to pull up the nat gas, like the 12-month strip. What has that done? Let's go have a look at it. Well, you keep talking while I'm doing
Well, what I was just going to say, we've returned back to the February low on this Jan contract, and we finished a couple of these technical measured moves. I actually think this is a support line that could hold. Now, I'm not going to get bullish outright, but I think that a reaction back to 270s in the cards here. I think that on the short term, there's going to be a little bit of recovery from a very oversold condition. I think that's where we're at with that. What do you think?
From your lips to God's ears. Okay, what do we got for number 1 thing we're watching next week?
Well, we're obviously bonds have been under stress as the 10-year yield is edging towards that 1% level, and it was you that wanted to ask whether this is going to crack the stock market, right? Like,
well,
I mean,
think
first
it's
of all,
definitely a thing to watch
do we go north of
about
1?
it.
Are we going north of 1?
You know what, Patrick? That's like asking, there's a bear shit in the woods? Of course I think we're going above 1. You know me, I'm always bearish on bonds. It's a dumb question.
All right. Well, you know what? I wanted to hold you on. Like I think that we can see 110, but I'm not so sure we're going like to 130, 150. But definitely a punch above 1. I'm with you on that. It really feels like it's there, and we'll talk about that in break evens in a moment. But what's your thinking in terms of its impact on the stock market? Is what I'm more.
I actually think it's BS. I know a lot of people are talking about it. They think, the bond market backing up this is going to cause such a weight on stocks. Yes, I think things like Apple and maybe some of the long dated, like long duration growth stocks will struggle under that environment. But I just think it's going to cause a rotation. I think stock market's fine. It heads higher, even with bond yields headed higher as well.
All right. Well, I'm going to take a much more neutral stance on that because I think that it will start to trickle in, and those mega caps are the ones that are going to drag the index. But I still think we go higher in the next couple of weeks, so we'll see. What I wanted to, though, talk about is let's go back to the bonds, because what's interesting is the 10-year yield's been going up, but that's not really the most interesting part of the story. It's about break-evens and inflation expectations, because we certainly have seen inflation expectations start to rise. And I typically track that RINF, but here we got the Bloomberg snaps on the 30-year inflation break even, and more importantly, here's that longer term 4 or 5 year chart, and we're really looks like we're breaking out and edging toward those 2017-18 highs. At least we're targeting them, as those first of all, do you think it's just the oil breakout that has really got the tailwind behind this this kind of everyone fearing that inflation is coming back?
No, I don't think it's oil at all. I think it's the fact that people are waking up to the realization that when we have fiscal, we can make the inflation that has eluded us for so long.
Hold on,
and to me, these things are still dirt cheap. So the 30-year break even. So that's the market is telling you that the Fed is going to achieve their inflation target over the next 30 years. What, really? Like, you don't think that there's a chance they're going to overshoot?
I wish we had Eric back on the air here to give you a shot on the back of the head.
Every trade needs another side, and I'm happy to be on the other side of Eric and Lacey's trade. Like, that's fine. I think it's headed a lot higher, and that's what makes the market. And it's not like I don't get things wrong, but so far it's headed that way. And you asked me why I think it's headed that way. It's headed that way because people are figuring out that the fiscal's changed.
I think the commodity bull market has a lot to do with it, actually. But
I'm not trying to say that the commodities don't have commodity bull market doesn't have something to do with it, Patrick. But we wouldn't have a commodity bull market if it wasn't for the fact that fiscal had changed. If we were still stuck in the old environment of trying to fix everything with monetary stimulus as opposed to using fiscal, I don't think the commodities would be doing this. Yeah.
Anyway, that's the interesting thing. Like, and I wanted to just show that chart on one of your favorites, the 530s spread. And you can see, like, it's trying to break out. And after a consolidation like this for a better part of, almost a month and a half, with this breakout, it really does open the move up to 140, 145. And that would correspond very well with a 10-year going to 110. I think that's even though I don't think that the yields are going as high as you do, this is certainly the path of least resistance, and I'm not going to fight this.
So at this point, I want to talk a little bit about a certain product, and it's
and the IVOL.
Right, it's a friend of the show. Nancy Davis is the manager. She's been on a couple of times, and she's been the manager of IVOL. And the thing about IVOL is it's a combination of a product that's hopefully going to benefit from increased inflation expectations and also a steeper yield curve. And wow, it's time for this thing to shine. Can you pull up that versus TLT?
Sure.
Because here we are, TLT getting crushed, and maybe you could just, there we go. So what's that? That's since April?
Yeah.
Since April, TLT's down 6%, IVOL is up 7%.
Yeah.
And this is exactly the reason why you own IVOL, is because with a steeper yield curve and inflation expectations going up, it's going to protect you. It's going to do a different thing than the regular bonds.
Yeah,
so good for Nancy. Like, it's she's great. And
I love the
product doing well.
At Big Picture Trading, like for the bond component of portfolios, I've been pitching this to members for a long time. It's definitely one of the better ways to have a bond component of your mix. I love it.
Yeah,
anyway, so
we'd have her on again, except that would probably be the top in this thing. So in the interest of having this thing continue,
let's not do that.
We'll wait.
Anyway, what I want to talk about? Like we've been talking. First of all, let's talk some of these commodity stocks. Like let's start with iron ore. Let's go with like Rio Tinto, Rio Tinto, Vale. Look at the way that this Brazilian iron ore plays thing.
It's running like it stole something.
Yeah, BHP Billiton. Like, these things are running. Even look at Tech Resources. This is more of a diversified play in Canada here, but like, what a day.
Yeah. Wow.
These things are ripping. Even like the ag stocks like Nutrien or Mosaic. Like, look at them going. Like, there is a full on, like, if you leave gold
global
miners,
synchronized recovery come next summer, starting next summer, Patrick.
Yeah.
Markets are
and how about those
mechanisms?
how about those copper stocks? Let's use COPEX, the ETF for copper stocks. But like, this has gone Bitcoin parabolic.
Come on. Yeah.
Let's compare the performance. I got to see this. I don't know. Like this, maybe I'm just like shitting.
Let's see Bitcoin. But the thing about this, though.
All right, look at this. All right.
Bitcoin is the kind of asset you can put 100%.
But look at the correlation.
Patrick, 1 second. Bitcoin is the kind of asset you can put 100% of your net worth in because you feel it's a stable thing that won't get devalued in a fiat system. Yet copper stocks, you can't do that kind of stuff. That copper stock's just too crazy.
I'm not going to say anything. You're the worst. Okay, so, but look at that. Like, for all you could have been loaded up on copper stocks and gone toe to toe with Bitcoin.
Yeah, that's true. Who would have thunk it?
Well, I mean, I know a few, but anyway, let's not start naming names. But the other interesting thing, though, that I wanted to talk about is are we seeing the beginning of a new breakout on uranium? So let's start.
That
with
was today, right? I did all of a sudden out of nowhere, they all went big.
Yeah. Look at that. Like, look at uranium. This is the participation unit turning up. But like the uranium stocks, like let's just use Cameco for the sake of the thing. But look at the way that ripped today. Like
it definitely felt like somebody big was putting in a buy order in Canada and buying a lot of these kind of resource stocks. They were getting chased.
But this is a legit breakout. At Big Picture Trading, we published this a couple of weeks ago, but it was just around $10. So it was a great day. Like,
good for you. I think I heard
nice
there was
turn
a big overseas pension allocation after reading the Macro Tourist article about buying Canada. It was
Your shameless plug. Shameless
that's
plug.
Hilarious. That's funny.
All right. Anyway, but interesting breakout on that. I thought it was a thing, but let's go back to the markets. So anyway, uranium is breaking out these resources. You know what? Let me ask you this though. Like, are you not getting a little bit worried that these commodity stocks have gotten a little too frothy?
I guess so, but like, what isn't frothy these days? Like,
I've been fucking putting in collars on all of my copper stocks, and the calls just I have to keep rolling the shit up because the thing's going up too quickly on me. But it's like at some point this has got to have like a moment where mean reverts a little bit. Like it's crazy that it's like outright FOMO on resource stocks.
But Patrick, this is back to my theory about there being a rolling bubble. So it's everywhere, and the key is to just not don't get cute and
don't get cute.
Listen, any pink ticket any stock you start with a pink ticket first, you're in trouble. Like our joke is always the only thing that's that you can go home short is the S triple Qs, which is the inverse Nasdaq's, because anything you sell is just a mistake. And you're talking about the craziness in the resource stocks. So what about Tesla? Yeah. Like one of the largest companies in the world, and it's just going up like a Vancouver penny stock. So shit's crazy.
Well, crazy Kathy is
she's
got
buying
her,
it.
Yeah. She's got it going. Like, I mean, listen, if Tesla breaks to a higher high, this thing measures to 700. It's insane. It's insane.
Next week. It's probably going to be there.
At the velocity it's rising, that's not a joke what you're saying. Like, that's like it literally can. Like, and you know what? I just don't want to be the bag holder when this thing turns. One day Chanos might be right, but like it's like, what did he start shorting the thing at 100?
Yeah, pre-split.
Oh my God.
You know what I thought was hilarious? He got interviewed on Bloomberg, and he talked about how he's reduced his shorts because there's some other better shorts in the EV land, and the headline ran, Chanos reduced his short, and that was like a cause to reason to buy it. Like, they interpret that as bullish.
That's hilarious.
Like, because he found bigger frauds to short. Anyways. So be it.
So
I'm short and wrong on this one. So I actually, someone asked me about it the other day, and I said I've lost all ability and authority to talk about it because I've been so wrong.
I put in a calendared spread on it, thinking that it was going to be more pinned, and at least it's not that bad of a burn. We'll see. As long as it starts pulling back in the next couple of weeks, I think I'll be all right. But man, does it feel like shit. Anyway, S&P 500 though, I wanted to just pull up this chart. And I was going to say, like, some of the areas that there's a number of these measured moves that all target like 38, 3,900. And with the way things are going, like, I'm not going to be shocked if we still have a couple hundred S&P points to go. I still think, though, that the sentiment is so frothy that something really bad has to happen inevitably. But on the short term, it is, I think, a fool's game to fight it on the very short term. It seems to have a life of its own, and this is a little too early to play the hero card.
So, Patrick, I have a question for you. I hear you talking about measured moves, and I'm confused always when you say that. What are you measuring it against? How do you come up with these numbers? What is this voodoo magic you talk about?
There's symmetry, and I can't give away the secret sauce, but there's a proportionality to the length of different moves, and so you're measuring them out for your targets on the upside. You should take a technical master course one time.
Folks, anyway, we didn't actually plan that. That was like I thought he was going to legitimately tell us. I didn't realize he was going to hold back. Okay,
what a douchebag
I guess like
move.
a true magician never reveals his secrets, and like we'll just have to go with that. It is all just voodoo magic, anyways. Okay, go on with whatever you want to talk about next.
Well, I just wanted to leave it with the S&P. Just it's working, right? Like, by the way, that dollar breakdown. What about that? Let's just leave it on this. Like, at this stage, not much is going to stop it from going back to those 2018 lows.
There we go.
Right?
True technician. It's going down.
No,
so it's
like
going to keep going.
Are you fucking buying?
No,
Are you buying it?
No, I'm not.
All right,
I'm not. I'm short. I'm short.
Look
like it's
at
one of
you.
my biggest positions. Like I can't, and I'm not covering it yet. But you know what? When I start hearing that, it starts to make me think I should. Okay.
Well, all right. Anyway, that is our little bad attempt at talking charts. So let's move on.
Okay. This week in trading history, Patrick, what do you have for us?
You know what? It's going to keep it short and sweet. I wanted to circle back. December 1st, 1998 was when the oil giant Exxon agreed to purchase Mobil for $80 billion. So I just thought it was really interesting to touch on because the combination of Exxon and Mobil would, at the time, create the world's largest company. And by recombining two of the former Standard Oil monopoly pieces, and the new company would be responsible for over 15% of all oil sold around the world at the time. Over the subsequent 15 years after the merger, it continuously fought Apple, Microsoft, and General Electric for the crown as the largest company in the world based on market cap. But how things change, Kev, because today Exxon has a market cap of $175 billion, while Apple has what? $2 trillion, right?
It's a big number. A lot bigger than
Microsoft is 1.6 trillion. Like, so each of them are 10 times larger than Exxon. And so even though for 15 years, I think the last time Exxon was the number one cap when it was a $400 billion cap. Apple at the time was $370 billion. And that was like 2013. And since then, it's just obviously oil started peaking in the next couple of years, and then it rolled. But what's interesting is that Exxon and both Mobil were a part of the original Rockefeller empire, which was Standard Oil. So that Standard Oil was started back in 1870 under Rockefeller, and by 1911. There was massive public outcry that went all the way to the Supreme Court of the United States for Standard Oil to be dissolved under the Sherman Antitrust Act and inevitably split into 34 companies. And two of those companies were the Standard Oil of New Jersey, which was also known as Esso, which eventually became Exxon, and the Standard Oil of New York, which inevitably became Mobil. And the two companies merged to create ExxonMobil, but they were all the original spin-offs of the Rockefeller empire. Anyway, that was the rise, and now how it's amazing how the Titan has fallen. Hey,
the Titan. Well, there's new Titans, and
Titans.
And it's what they booted Exxon out of the Dow Jones recently, right?
I don't think so. Did they?
I think they did, Patrick. Are they gonna?
Anyway, I thought it was still in there, but anyway, maybe I'm wrong. So, anyway, that is This Week in Trading History. But it's time for No Stupid Questions.
Only stupid answers.
And Lena, come on to drive the stupid answers.
We're going to have to try a little harder to not provide stupid answers. Mm-hmm. All right. The first question of the week. Great show. it's 3-part question. So how do you evaluate putting on a call versus a call spread as they are both directional trades?
All right, so let's take that first. Kev, can I take this?
Oh, for sure, buddy. This is your expertise.
All right. Well, the difference is that when you just buy a call, you're buying the delta and gamma and the convexity to the upside. That when you're buying all of that right tail upside. And so you have an undefined and in some degree unlimited upside if the stock starts ripping. While a call spread, you're buying the upside, but only a specific part of the upside. Right, like, and that's the spread between the long and the short position. It's often a call spread will have a smaller capital outlay. It's cheaper. It's easier to manage the risk, but you're only buying a part of the upside versus having that kind of the convexity of the unlimited upside that comes with a call option. Do you have something to add to that, or is that a pretty good way of summing?
You're the master.
Oh, my God. Don't do that. All right. Anyway, Lena, what's the next part?
So the second question is, how do you think about managing P&L on short-dated option trades?
All right. Well, managing short-dated options are the most volatile from the Greeks' perspective, right? Highest gamma, highest impact from changes in volatility in vega and every other element, theta's the burning it. You have to, for short-dated options specifically, I often approach it that if you're wrong, the option is getting zeroed. Like trying to manage that with stop losses or something like that has... you're just going to get whipped around on it. Whenever I deal with shorter dated options, I usually consider that to be the risk allocation of the trade, and I look at it, and that changes it. I'm going to just go on to the second part there, Lena, which is that on all options trades, and I think that that's a very big distinction. When you're dealing with very short dated options, it's really I look at it as a much more of an all or nothing kind of trade. But once you're getting into longer dated options and particularly different types of option strategies, it's much easier to build different risk reward profiles and different ways of managing the trade. And that's very open-ended. So I only look at that kind of binary outcome on short-dated options. Anything to add to that, Kev?
Patrick, you're just nailing it time and time again. I don't have anything to add.
All right. Okay, Lena, let's go.
Next question.
So the next question from the second listener, the thought crossed my mind to sell the at-the-money GLD put and use that to buy the at-the-money GLD call. Is this genius or idiotic? I love GLD as an on-the-mark buy at 165 and don't mind it being put to me if it goes lower. Am I missing something here? Love the work. Life-changing content. Keep it coming.
Kev, can I do this or you want to do it?
No, you're going to do all of them today.
All right. Well, this is just simply a synthetic long, right? When you sell a put, you need to come up with the margin that's often equivalent to carrying the margin on a long stock position. And you're using the proceeds to buy the long call. And being at the money, the premiums are often very equal. And so it's just going to give you a delta 1 experience on the stock, which in itself, it's not idiotic nor genius. It's simply just a stock replacement strategy. And it's something you can do. I mean, I think you want to add some sort of optionality to this versus doing it outright this way. One of the interesting elements about gold, in particular GLD, is this skew is not fat left tail the way we typically see for the vast majority of beta 1 securities. And so you can actually do all sorts of creative option strategy on GLD that you can't do on a lot of normal stocks. So there's lots of room to be a little more creative with this trade, but I wouldn't call it idiotic. It's just a stock replacement. Anything you want to add to that?
Well, I was just going to say, if the reader or listener changed his or her, I think it's a him actually. If you changed the strikes to make them so they weren't the same, it would no longer be a synthetic long. So if they sold a 160 put and bought a 175, or then it would have an optionality and it would vary. But when you go and you sell a put and buy the call with the exact same strike, if you think about it, it moves 1 for 1, and you're going to end up long at the end of it regardless.
Yeah. No, what's really cool about the GLD is that fat right tail that it has, and it makes it really actually useful, or it makes putting on bull call spreads actually really.
I know. You know what, Patrick? I kind of hesitate to do that because to me, it's that fat right color
Yeah,
you want.
Oh my God, you're the one. You still think that you're going to have $1,000 gold update one day?
No, I said $1,000 a week. It's going to be a week.
A week, okay. So
week.
not a day, but a week, because it can't go limit up 5 days in a row, right?
Listen, when we're old and in our homes talking about the great trades we put on, you know what? And it didn't happen. You can say, you remember when you told me there was going to be $1,000 a week? And
All
you know
right.
what? And if I'm right, I'm gonna hold you to it.
All right.
Okay.
I hope my account won't be upset about you being right. So
Okay.
that's okay.
Lee,
All right.
now, why don't you tell us where they can send their questions? And thank you for everyone for the questions. There's a lot of great ones. We got some other ones that we want to get to, but where, for those who are interested in sending more, where can they send it to?
They can submit their questions to nostupidquestions@markethuddle.com.
Okay, great.
All right. It's time, Kevin. Skin in the game.
Yeah, so
you got one, buddy.
I got one. So it had been 2 in a row that I'd lost. I thought I'd lost my mojo. I thought he was like Austin Powers.
I gave you a very clean over-under to pick, and you took my
I'm going to
trade.
give you
I
a
was
clean
hoping.
one this time too, so you won't be able to complain. And,
Thank you.
Okay.
I appreciate this. All right. So,
but I
go
did win.
through
So why don't we
quickly
tell
through the rules.
people what it was that we bet on? Or should I tell people the rules?
No,
Why don't I tell
the-
people
the
the
rules, yeah.
Skin in the Game is a weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other guy chooses which side of the bet he wants. Every wager is settled by next episode, and the currency is, I'm not going to repeat it. Everyone knows it by now. The winner of the bet is obligated to create a new bet for the following week. So in this case, it is... no, we got that wrong, right? It's the the winner of the bet. So I won, so I'm going to go again. And all wagers settle in full, and there will be no netting of the positions. This is like
so important.
2008. No netting of swaps, no netting of beer trades. Okay,
Yeah,
so what did we bet
All right.
last week?
We did the euro yen.
Yeah, you thought you were going to trick
and-
me because I liked the yen so
no,
much.
but you know what?
Don't lie. You were trying to trick me. And
I didn't. It's not trick. I gave you if I moved the strike, it would have tricked you. I gave you literally an at the money choice. So
Yeah.
I really was just hoping you were going to choose the other one.
I know.
But anyway,
I
it
chose
went straight
right,
up.
and I won.
It went straight up.
Wasn't even close. Okay, so now
It
it's
was
my
not
turn,
even
right?
close. Yes. So you won this one, and it was just a pint, right? I think we just did a pint of beer.
I can't remember.
You guys did
Lena
pint of
knows.
beer.
She keeps track of it all.
Yeah. I think it was.
Yeah.
All right. You know what? At one point, we haven't actually delivered on any of these contracts. We have to actually put this up next week to actually show everyone what ridiculous payment we have to make here in the coming weeks.
And we also listen. As soon as the vaccine comes and we're allowed, I still have to honor my market Huddle menswear. And we have our 5 winners that are going to come to Toronto, and I'm going to wear it, and we're going to go out, and it is going to be, we're going to let loose like nobody's business. It's going to be wild. I'm looking forward to it already. It's going to be epic.
Like nobody's business. All right.
Nobody's business. Okay. So Patrick, you inspired
What's
me
the bet?
in terms of how you went about giving the bet.
Oh, okay.
So
All right,
we're going
all
to do the lead month in crude oil futures.
Okay. So we're just
So
Jan.
I just want to make sure, does the Jan, I got to make sure it doesn't expire before next, when does the Jan expire?
No, I think you got a couple more weeks.
Last trade on the 21st. Okay, yeah. So we're going to do Jan. We're going to do Jan crude oil futures.
Yeah.
It's sitting here at a new high, new closing high.
Yeah.
Very simple, Patrick. Up or down from here, you get to pick, buddy.
Up.
Ah, you bugger. I didn't expect that.
No, I have a target of like close to 50.
Oh, you
I'm
didn't even
thinking
hesitate. Well, I blew that because I was expecting you to go the other way. Okay, you got me.
But you know what? We'll find out.
Now I'm going to win, but it's going to be like it's not going to be a real like.
Oh well, I'm starting it
honorable
as a
win.
burger bet. No.
You're going for the
No,
burger bet?
Actually, we have to. Are we allowed to do that where we start? No, I think
No.
I have to start at the Duke and Duke.
I'm
right?
leaving a Duke and Duke. I wanted the other one. That's it. It's just a crisp dollar bill. That's it. That's how much I believe in that trade.
Oh my God! All right.
Really boring.
There
I
it
know.
is. It's so boring. Everyone's disappointed, but that's okay.
Okay.
But I can't wait until we bring this up to like a bottle of wine or a steak dinner here because we seem to be pretty soft on our bet.
Oh yeah, you
betting,
know what?
like-
It's true. We should pick one.
No, but it has to be a high conviction bet that we're both convinced
I know.
we're going to be
It's
right
kinda
on,
like,
and
you know,
it's going to happen.
It's like
Let's not force it.
backgammon when you really feel
Yeah.
and you go for it. You keep doubling each other to whatever the number
Yeah.
is. Okay, thanks
yeah.
for tuning into
All
the
right.
Market Huddle. We appreciate you spending time with us. Please give us a follow at Twitter at the Market Huddle. We're there every day. Give Lena a shout out. She's in charge of that account. And now listen, you can listen to the Market Huddle on all networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people watch on YouTube to see all of our charts and visuals. And while you're there, please like and subscribe to get our latest content. And you know the rules. If you can, please give us give us a review on iTunes. It helps us out immensely. Patrick, where can they find you?
You can find me on Twitter at Patrick Ceresna, as well. You can find me at bigpicturetrading.com. And Kev, where can they find you?
I'm at Kevin Muir on Twitter, and you can go check out my newsletter at themacrotourist.com. And listen, we can never have too many friends. Bear market, bull market. We're just happy to spend some time together on this crazy ride first. So thanks for tuning in. Now stick around for the after show.
All right. Lena, hop on.
Another one in the bag.
Yeah.
Okay.
I loved this beer.
I know this beer's pretty
I
good. So
gotta
let's
say, I
just
really like
polish
this
this
beer
off
also.
first. Let's get this out of the way. Who wants to go first?
I can go first.
Okay, Lena.
Go for it, Lena.
I thought it was going to be super fruity based on the description, but it was really, really good. I finished it. It's very rare that I finish the beer before we finish recording it. So I would give this 9.2.
Oh,
What?
nice.
I would drink a
crazy.
6-pack of this on my own. Yeah.
I know what's nice is that 4.5%. You can still edit the show.
I hope so. I'm kind of hanging on by a thread right now, but I'll make it work.
Patrick?
All right, Kev, go.
Oh, okay,
Or
I'll
me? All right, okay, I could go. Okay. You know what? I liked it. Maybe not as much as Lena, clearly, but you know what? I'm going to give it an 8.9.
Oh.
I enjoyed it, and I'm there. I like it.
Well, you know what? I honestly was going to go 9.1 even before you said 8.9, and so I'm going to go right in between. I taste the grapefruit, which I think would sounds disgusting, but it actually works, and I really enjoyed this beer.
All right, there we go.
Wow.
Well, that was a half decent.
Wasn't there
show.
something we were going to talk about? I said we got to talk about this in the after show.
There's always something we need to talk about in the after show, but by the time we finish our beers, we just
I know, I always forget.
all about.
You know what? I actually for the first time in how many years I actually went onto Netflix and I crushed the Queen's Gambit.
Oh,
Get
nice.
out!
I finished it, right? The whole
Me
episode.
too.
Did you do it in one sitting and basically
No,
start at
I
10
did it
and-
over
and,
3
and
days.
at 4
No,
in the
no,
morning
I did it.
you're like,
I did it
gotta
in
go
3
to bed?
3 back-to-back days.
Did you, Lena? Honestly,
Almost. I watched I don't remember. It was 8 episodes or 10 episodes in total. I watched all.
no,
of
it's
it
only
except-
7, I think.
Oh, is it 7?
Yeah.
Except for the last episode, I watched all the other episodes in one night.
Oh, you did a 6-pack of Queen's Gambit.
How do you think I finished Netflix? So it was really good.
Are they an hour
Yeah.
each? So you sat down for 6 hours and watched. I'm gotta look this up. Queen's Gambit length. Let's just go look at how long these are.
Let's
Yeah,
tell
it's
people
they're
how I
hour
don't have a
episodes.
life.
Oh my god!
Clearly, I don't give you enough work.
I just found out that it has 100% Rotten Tomatoes.
Oh well,
You know,
there it is.
yeah, there it is.
Is that bad?
No, Rotten Tomatoes.
I don't even know how to rate.
awesome.
Oh, yeah?
Most reliable source, didn't you know?
No, I didn't
It's
know.
not even close. It is.
You know what? I here my personal rating of the thing. It was good enough to finish, but it wasn't spectacular. I would recommend it. I wouldn't tell people not to watch it, but I also wouldn't want to accidentally work it up to so that people are disappointed because you kind of work up the episode. It was a great watch. I finished it. There's a lot of series that I'll watch 1 or 2 episodes and I won't You know how you try to get me into what is that?
Succession.
Succession. Yeah, I got about 4 episodes in and I never finished it. I don't. It's not. I'm sure it's good, but I just stopped. Right. And
That's a shame.
and so there's very few. There's very few shows that I will actually go and finish the whole series. I think the previous one that I did before was that Chernobyl series.
Oh.
What was that? What was that?
Okay.
You remember that?
Yeah, because it was
5
like it
parts?
reminded you of the homeland. Ah, looks just like back home.
I felt so. Yeah. Oh my
We
God.
have
I'm not
ladders
gonna.
like
I'm not even gonna say anything. You got your joke, and congratulations. All right.
But
I'm done. All right. What do you guys?
we
You
gotta
guys done?
we gotta talk about this Twitter thread that was going on about you, Patrick.
Oh yeah, that
you know
was
exactly
a good one.
which one I'm talking about.
Yeah, well, that was the one where let's get the fellow's name because he had a
Yeah,
great
I'm looking
line.
for it now.
He not only did he reference us, he also incorporated Old School in there, which is just awesome.
Yeah, it was perfect.
So
One of the greatest
It was
movies
it
of
was,
all
it
time.
was Patrick on the Market Huddle versus Patrick on the other show.
That's right. And so Patrick on the Market Huddle was Frank the Tank right before he goes streaking. And then the Patrick on the other show is like when Frank the Tank goes and
Do the
what does he
debate.
go to the debate and he like comes up with all these great things.
Yeah.
And it's just awesome.
This is a tweet by Aussie Byside.
Oh, you knew it was going to be an Australian guy that had
Oh, this is
good humor.
Oh yeah.
Lots of good gifts going around in this thread.
Yeah, I must say. Great movie. One of the all-time bests.
Oh, it is.
Yeah,
Like
It is.
for
like
sure.
you watch it again and it's just awesome. Genius.
So after the we reran the WTF with Tropic Thunder, I realized that my kids never saw it. So I basically went.
Are they old enough to
and,
watch that?
yeah,
well,
he's
they
11,
are-
of course.
Yes, I sat him down and we crushed it and they all loved it.
I
They
also-
loved it.
He also had his
They-
first six-pack that night.
Oh my god. Well, he's not 10 anymore, so that's great.
Yeah. You're 11 now, son. Here's a six-pack.
That's right.
No more of these singles for you.
Start them early.
I actually have a funny story about. I think I was 12, and my dad. We were at the cottage, and we were at a friend's cottage, and he gave me one of my first beers. And then we used to have ours was water access, so to get there you had to get a boat. And somebody was over there and needed a ride, and they were all drinking and they didn't want to leave, so they said, "Kev, go pick them up." And they watched from the deck. And they watched me drive all the way across the lake to try to get this guy. And it was a long ride. It was like 20 minutes, but it was big open water. And they said it was like I was weaving and all this shit. They thought this was the funniest thing they'd ever seen.
Well, they were drunk, and you were 11.
I was 12.
Oh, 12.
Oh my-
Yeah.
Yeah.
That's
You'd
hilarious.
be surprised how quickly it goes. But it's just funny that he puts me in a boat. You know, how times have changed.
Oh yeah, that
Yeah.
would be you'd be arrested by now, or your dad would be arrested by now.
Well, my dad tells me the story that when they were in college, they used to university, they used to come in and they find somebody would park on the lawn and have missed the driveway and they think it was hilarious. But he was always really strict about cars. Like he says, if I ever caught you drinking and driving, or even in the car with someone who's drinking and driving, you're never allowed out again. He was super strict because he
Yeah, that makes sense.
he had coached these kids when I was young, and they were 16, and it was a hockey team, and they had wrapped their car around a tree and killed a whole bunch of them. It was a terrible story.
Oh my goodness.
But it was just funny that for some reason he thought it was perfectly fine to do in a boat.
There's no other boats around. As long as
I guess
there's no
it was.
other
Listen,
boats
we
around,
grew
I
up in a
guess.
very remote lake, so there really was nothing to hit. So maybe you're right, but he was
But
actually
don't-
very strict about drinking and driving. So I'm making this sound like he's like a lunatic. He wasn't.
Yeah.
That was the one thing he was actually the only thing I wasn't allowed to do, and
Yeah.
not that anyone should be allowed to do that. But anyways,
If you
I just
drink,
think-
do not operate any heavy machinery or drive.
yeah,
That should be our disclaimer also.
Yeah.
If you're listening to the show and drinking beers, please do not drive or
Yeah.
operate
if you're
heavy machinery.
chainsawing and flip flops, though, it's fine.
Now I've done that many times.
I know.
And
I'm the
I've
same
never
way.
How about
once
your
lost a
toes?
toe.
I have a question for you. Have you ever chainsawed not in flip flops? Like,
Actually, no, I have not.
yeah, like I'm the same way.
Because I'm
What
a
are you
cottage
using chainsaws
I'm a
for?
cottage chainsawer, not like doing it for a living.
Yeah.
So like it's you want to stock up your firewood for a nice awesome bonfire, right? Like you walk out there in shorts and flip flops and you fire it up.
Lena, at my old cottage, we actually, my father-in-law came, and there was this one tree that was dead that I wanted to take down, and it was a big ash tree, and an ash is a hardwood.
Yeah.
And it was big, like it was like two people could barely wrap their heads or arms around this thing. And it took us all day. I was sure we were going to kill somebody. Like it was the most dangerous thing ever.
I was gonna say, I'm surprised you didn't,
because it was so, we didn't have a big enough saw, so like it wasn't going through, and we're trying to chip away at it, and you're never sure when it's going to go, and then you're trying to get out of the way, you're not sure which way it's going to fall. Just a shit show. People die all the time doing that stuff. Like you really shouldn't do it. But if you're going to do it, make sure you're in flip-flops.
I remember at my other place, there was a tree that was in the Hyde Park area, and this tree fell right on the cable lines. Like a huge branch broke off and it's like lying on them. And the hydro guys came and they're chainsawing this thing off of it. And the guy cutting with the chainsaw, I don't know if they didn't realize that it acts like a slingshot. This thing was like fully thing. And so as he cut it, this branch went flying like a kamikaze flying through the air, like missed this guy's head by literally inches.
He knew. He just like, oh, that's close.
He had a death wish,
no, like
maybe.
That's close.
I was like, I was.
Hey, Bob, eh? Hey. That was close, eh? Be careful next time, eh? I love guys like that. It's close, eh? You know the kind, Patrick, when you go to the cottage and you're just like...
No, I know.
Oh, everybody
close,
must
eh?
think that that's how we all talk over here.
Well, we do.
Do we? Is
Bob
that
Bob
right?
and Doug have done a great job representing, right?
That's true.
Oh, my God. All right, guys, I got to go get some dinner.
Okay. Thanks
Yeah.
for everyone for tuning in. See you guys next week.
Yeah, see you, everyone. Cheers.